raised to power 2 because it is 2 periods. 3, 400,000, 1 plus 1, 0.05 raised to power 3 because it is 3 periods. And then 4, 500,000 into bracket divided by 1 plus 0.05 raised to power 4 because it is to the 4th period. So all of them are now, NPV is this, when I simplify each of these, so effectively what I'm simply saying is that 200 million is actually equivalent to 190.48 million that I'm collecting now. Assuming I'm collecting the money now, if I'm waiting to collect 200,000 next year, I will collect 190.48 now. The two of them are equivalent in terms of their purchasing power, given the discount factor. 300,000 or 300 million in 2 years' time is actually equivalent to collecting 272.11 million now. So all of these are now, I've brought them down into their value today, as if I'm collecting them now. So they are now in their present value. So the net present value means when you net the negative from the positive. So minus 1,000 plus 190.48 plus 272.11 plus 345.54 plus 411.35 gives me a net present value of 219.47 million, which definitely is positive, and that means the positives are more than the negative. This is a profitable project, and I will recommend that we should go ahead and adopt that project. Any question on that? That's example 1. Yeah, Mr. Tosin. Go ahead.
Tosin,
go ahead.
I'm trying to think in net present value. We don't factor in inflation to get the real rate of return.
All of these have taken account, all of these cash flows have taken account of inflation.
Okay.
Yeah, there's already inflation in all of this.
Okay, so the rate we are using here is the real rate of return.
The rate of return, yeah.
Okay.
I know what is Tosin is saying. Now you can, there's a level you can do. You can go into some more details and say this is an a real rate of return, nominal rate of return, and all. Don't worry about that yet for a lot of my people in this class.
Okay, sir.
So we are assuming we are using the real rate of return at this particular point in time.
Okay.
Not inflation.
Thanks,
now I use a simpler method for people to understand. Now this method we are using is straightforward, it's easy, but maybe the second method might be easier for somebody else. So the same thing we have done, the same question, minus 1,000 in year 1, 200, in year 2, 300, in year 3, 400, in year 4, 500. Discount factor at 5%. Now I can use my calculator to get all of these streams of items. This one, 0.952, and so on and so forth. Now, when you want to do discount factor, what I'm simply doing is this 1 over 1.055 raised to power 1 or 1 over 1.0052 raised to power 2. It can be simplified using this, what we call the discount factor at the different levels. How do I do it? If you have your calculator, bring your calculator out and use your calculator to understand what I'm trying to say. So in my calculator, if I say, don't forget that year 0, I told you, is already in present value. So year 0 will always have a discount factor of 1. This 1 is constant for year 0. That's why we are putting 1 here. Because minus 1,000 here will remain minus 1,000. So the discount factor is 1. It's nothing is discounting it. That's what it means. Now for year 1, I can now say, use your calculator. Punch 1 divided by 1.05, because we are talking about 5%. So remember, the denominator is 1 plus 0.05. That's how I got 1.05. So say 1 divided by 1.05. I'm sure your calculator will have given you 0.952. That's how we got 0.952. Divide it again by 1.05. That's in 1.05. 1.05. It will give you 0.907 as a discount factor. Then after you have done it twice like that, you don't need to punch anything again. Please wait first. Wait first. Let's finish. Then I will come back so that we are not distracted. So 0.907. That's for the second one. Now going forward, you just press equal to. It will keep on giving you these streams of items until you finish. Even if you have 10 items, it will just keep on giving you those discount factors. So for my own calculator, just press equal to after this one. You will discover that it will give you 0.864. Press equal to, it will give us 0.823. Press equal to, it will keep on giving you like that. So that if you have a long list of items, you can be faster in doing that using this method. And I will show you how to complete it. So somebody wanted to ask a question. I said you should raise your hand when you want to talk so you don't distract the class. Please, somebody wanted to ask a question, you can go ahead and do it. Raise your hand, please. So you can know who's talking. Hello? I thought somebody wanted to ask a question. Oh. Okay, let me take it again because I guess she wanted me to take it again, but I will do it again one more time. This is an alternative method. It's the same result you will get. And what's that alternative method? You have laid out your cash flows, and then you want to have the discount factors to discount those cash flows. And I said year zero, automatically just write 1. You don't need to think about that one. Year zero has a discount factor of 1, irrespective of this rate of return, whether it is 10%, 20%, 100%, whatever is this percentage, you put 1 here as a discount factor for year zero. Now, for year 1, now say 1 divided by 1.05. 5% is 0.05, right? The discount rate is always 1 plus that R in our formula that we have. So for this particular one, you will say 1 divided by 1.05. Everybody knows how I got 1. 1 is just that the numerator is the 1. The denominator is 1.05 because we are using 5% discount rate. So immediately from your calculator, you will see that 1 divided by 1.05 will give you 0.952. That's the discount rate for year 1 automatically. Now I want to get for year 2. I will keep the answer. I'm not touching that answer. I will just divide that first one by 1.05, another 1.05 again, because it's the second year. I'm going to do the discounting twice. That's why I'm doing it twice now. And it will give the answer to be 0.907. I'm now saying most calculators are automated. Once you have done it twice like that, it already knows that you want to keep on dividing it by 1.05. So by the third one, don't wipe out the calculator, just say equal to after that. Equal to, in my own calculator, it gives me the next one. Equals to 0.86, equals to 0.8227, which I summarize to 0.823, equals to for year 5, on and on and on and on like that. So I have the discount rate from year 0 to year 4, which are the relevant ones for this particular question. So what is the present value? Multiply the cash flow against the discount factor. Minus 1,000 times 1 gives me minus 1,000. 200 here, million here, multiply by 0.952 gives me 190.4. 300 times 0.907 gives me 272.1. 400 times 0.864 gives me 345.6. 500 times 0.823 gives me 411.5. When I add up all the PVs together, I get my net value. Minus 1,000 plus 190.4 plus 272.1 plus 345.6 plus 411.5 gives me net present value of 219.6 million, which is the same with this, with a slight approximation difference. So you see that we'll get the same thing, but our models. So please, I think what you should do is try the two, whichever one you find most convenient, easy to understand. Just stick to it. Nobody knows exactly what you are doing. You get your answer as long as you execute it correctly. Yeah. So question before we move to another model. This class is too quiet. I hope I'm not missing something. Let me check your. Okay, there's an information for some people. Those who are not able to log on via Zoom, you can go to YouTube. That YouTube information is there in the chat room. So you can send to your friends who are not able to log on so that they can go to YouTube and still enjoy the lectures. Even though I know that on YouTube they will not be able to talk, but at least they can hear us. Okay, so everybody says they are fine. Right on, we can go ahead. My only encouragement is please go and practice these things. It's the only way to master it. Go and practice it. Don't look at it. It looks sweet when everybody is doing it in class. When you're on your own, that's when you know whether you have actually gotten it or not. So please go and practice. Internal rate of return. I've already given you a prediction. I don't know what the examiner is thinking, but I can guarantee you internal NPV will always come out in an exam, whether in the objective or in the theory. It is even most likely going to come in theory carries you. When you look at past questions, you see what I'm talking about. So your ability to master NPV will go a long way in helping you to pass your exam. Internal rate of return. Now, internal rate of return is simply the discount rate at which the NPV of the project is equal to 0. Listen again. The discount rate at which the NPV of the project is 0. So you can either see that there is a very close relationship between the NPV and the IRR. So this is the formula of the NPV. In the last example, we decided what is the discount rate that the company uses. R, we said it was 5%. But assuming you don't know the R, you don't need to know the R of a company to determine the internal rate of return. There is an R from this my example. There is a specific R which is different from 0.05, at which this NPV will turn to 0. Let's assume that that R is X, or we call it the RR, that's the RR. There is, instead of this 0.05, there is one particular R that if it is that R that we used here, this NPV, by the time we sum everything up, it returns to 0. That particular R that we don't know now, but which we can determine, that will make the NPV turn to 0, is what we call the internal rate of return of that particular project. Okay, so can we determine it? Yes, we can determine that R that will make the NPV equal to 0 for any particular project. How can we determine it? RR can be found by computer or calculator or manually by trial and error. Let me also add that you can use Excel for it. For those who are familiar with that, you can use things like Excel spreadsheet. There's an Excel, something that can help you to get an IRR for a project. Now, how do we decide? We'll take an example, but before we take that example, let me tell you, how do you then use IRR for decision making? Now, if the internal rate of return project is greater than the cost of capital for that particular company, then you will accept the IRR, because is the rate of return of that project. So if the rate of return of a project is 20% and the cost of capital company is 10%, it makes sense that the rate of return is already more than the cost of the capital. There is a spread of 5% gain for the company. That's why we are saying when IRR is greater than the cost of capital of the company, you will accept project because it means that the project is yielding more to the company than what it costs the company to invest in that particular project. That is the IRR. But once the IRR is less than the cost of capital, that means the project is more expensive. It's costing the company more than what the IRR, the internal rate of return is. Therefore, you will reject the project. So accept a project when IRR is greater than the cost of capital. Reject a project when IRR is lower than the cost of capital. So how do we calculate IRR practically now? Now, you can use your calculator. Many of you have scientific calculators. Scientific calculators can help you to compute IRR. If you use Texas Instruments, if you use some of these calculators, they will guide you on how to calculate the IRR of the project. I may not know your own particular calculator, so I won't be able to tell you that. You can just study the manual of your calculator. How do you use a calculator to get IRR? Graphically, this is what IRR is telling you. IRR is telling you, look at the NPV. NPV is here on this scale, on the y-axis. IRR is on the x-axis. You see that NPV is 0 on this line, for those of us who are mathematically inclined. At this intersection of the y and x-axis, this is why NPV is 0. The IRR at this point is 20%. So the IRR is the discount rate at which NPV equals to 0. That's exactly what we just said. So because with IRR being 20% here, NPV is equal to 0 here. Graphically, that tells you what it means. I've already explained this. This is the decision criterion. When IRR is equal to or greater than the required rate of return, you accept the project. When IRR is less than the required rate of return, you reject the project. So what are the advantages and disadvantages of IRR relative to NPV? Then we'll take that practical example on how to calculate IRR. One, it has the advantage that it also takes account of the time value of money. See, very similar to NPV in all its ramifications because it's actually derived from the NPV, as you can see. It uses cash flow like the NPV, adjusts for the time value of money, accounts for all cash flows, and the project IRR has an intuitive appeal, truly, because really, easily you can know what is the return from this project, which is what the IRR means. If you say 35%, I can easily understand 35% is the return that this project is giving me. It's not as complex to understand as NPV. And then I can easily compare that return on the project to my own cost of capital. My cost of capital is 15%. IRR of this project is 35%. It makes a lot of sense for me to see, look, there's a huge gain that I'm making when I invest in this project. But there are some problems with IRR as well. One, when it comes to lending and borrowing decision, it can create a bit of complexity as to how to calculate it, how to determine it. We are not going into the details of the mechanics of that in this class, but know that in lending versus borrowing decision, which you can apply IRR to do, it can bring in some complexities for decision making. Two, there are several cases where you have multiple IRR for a single project. When you have multiple IRR, so you can have IRR at a lower stage and another one at a higher stage. So it creates a problem for decision making. It's not a single figure like an NPV, which you can use. There are also situations where there are no real solutions with the IRR, depending on the pattern of cash flow. There's a type of cash flow pattern that we call unconventional cash flow patterns. Unconventional cash flow patterns always create that situation with IRR. What do I mean? A conventional cash flow pattern is when at the beginning you have a cash outflow minus 1 million naira. That's in year 0, the amount you spend. And then subsequently, you then have positive cash flows for the next 5 years, for the next 15 years, and so on. That's the conventional cash flow. But we have a situation where, okay, a company has negative outflow at the beginning. Year 1, it still has negative. Year 2, it has positive. Year 3, it has a negative. The next 3 years, it has positive. the next 4 years it has negative. It's no longer conventional. So with unconventional cash flow situations like that, you run into situations and challenges where you then have either multiple IRR or even no IRRs at all from your solution. You can't get an IRR, or you have multiple of them. How do you interpret them? How do you decide what to do? And so on. So it creates that complexity with IRR. And finally, IRR and NPV rankings do not always agree because of the situation that I just mentioned now. So if they don't agree, it creates a problem for decision making. But like we have said, if you have to make a choice between the two models, you are faced with a choice, there is a conflict between IRR and NPV, you would rather stick with the NPV decision rather than the IRR. So how do you determine IRR? I told you two things. There is the manual method, which is what I just quickly want to run through. Then there is the second one. There are the method that you can use computer software and things like that to solve. In your exam, because you have most of you are allowed to use certain scientific calculators, I don't know, or maybe on your system, you can use your calculator to get IRR. And then you can use Excel to get IRR. If you want to do the one of Excel, note it down. Just go to the Excel, check. You can Google that thing and say, please, how do I determine IRR using Excel? It will guide you on what to do. So that can be done. But this manual one may be the one you may want to just quickly learn, so you see the sense behind what we are trying to do. So what do you do? For any project, you need to choose two discount factors by trial and error. So how do you do that? Let's say you have a project. Let me start with 10% as a discount factor. I will use 10% discount factor to discount the project and determine what the NPV will be at the end of the period. Now, if I start with 10%, it's just trial and error, like we just said. You can start with 15 in your own. I can start with 10 on my own. And then I will note whether I'm getting a positive or negative NPV with that 10%. So if with 10%, I got a positive NPV, great. I now need another discount factor, which will help me to get a negative NPV. Now, if 10% gives me positive NPV, it means I need to raise the discount factor high for me to be able to get a negative NPV from that same project. So I can say, okay, let me do 20% or 25%, depending. It's a try and error thing until I get a negative NPV. But with the experience, after some time, when I see the amount of the NPV that I got with 10%, I'll have an idea of how far I must take it before I will get a negative NPV. So the important thing is get a positive NPV with one, get a negative NPV with another. If 10% gave me a negative NPV, that means 10% is already high enough to give me negative. I must drop it down if I want to get a positive NPV. Maybe I'll bring it down to 3% or 4% for me to then get a positive NPV. Because if I raise it higher, I'll get more and more negative. So all of these are the things, So you get a positive NPV, get a negative NPV, and apply what we call the linear interpolation formulae. I will discuss what that formula will look like when we get here. It's right there, but I want us to apply it to this question. So in this question that we got, let's find how to calculate IRR. Consider the project we earlier did. We have the cash flows, we have all of this. The IRR is the ratio rate that solves the problem. This is what exactly I was saying. 0, NPV must be equal to 0. It equals minus 1,000 plus 200 over 1 plus IRR raised to power 1 plus 300 over 1 plus IRR raised to power 2 plus 400 over 1 plus IRR raised to power 3 plus 500 over 1 plus IRR raised to power 4. So what is this IRR? This unknown entity that will ensure that all of this added together will give me 0. That is what we call IRR. So the way to apply it is the next slide will show us that. So what I did in my example, we already know what NPV when we apply 5% in that example, right? Let me go back. So assuming I started 5% discount factor, I will get 219.6 because we had solved this problem before. So we already know the answer in this one. It's the same question that I'm using. And we already know that with 5%, NPV is 219.47 million. That's what I'm saying here. So we know that to get a negative NPV, we need to raise the discount factor up higher. And that's why I'm choosing to raise it higher to 20%. To 20%. When I raise it to 20%, it gives me a negative number, minus 152.6 million NPV. So I have discount factors. One, 5% gives me a positive NPV 219.6. The second, 20% gives me NPV of minus 152.6. This is exactly the profile I want to be able to solve my problem using linear interpolation. Two discount factors, one gives me positive NPV, the other gives me negative NPV. So I'm giving an example, I'm giving a practice example to all of us. Solve and confirm that when you use 20% for that project, this project, when you use 20% to discount it, that you will get minus 152.6. I won't solve that in this class because we already know how to do NPV. All you need to do is to change the discount factor to 20%. Somebody is still talking in that class. I don't know why you want to unmute yourself when you are not speaking to all of us.
Which side you go? Go finish that.
It's not going anywhere.
Okay. Finish that. Carry me go that St. David side.
John Ademu.
Don't be straight.
Uche.
That for not just straight.
Uche. John. You are disturbing this class.
Hey.
Will I will send some people out of this class. Don't say because we are in professional class, somebody cannot punish you. I will remove you from this call if you are disturbing us. Okay. All right. So let's continue. Please let's reduce the distraction. It's wasting our time, and we have a lot of grants to cover. Somebody was asking a question. Let me take a question on the chat room. Sounding like a good question. Somebody says, let me take the questions on the chat room and then we'll move on. It says, my question is, why would we want the NPV to be zero? IRR is the rate of return where NPV is zero. Since we only accept projects with positive values, and most times the NPV is greater, no, we don't want NPV to. We are saying there is a rate of return at which NPV will be equal to zero. What is that rate of return? That rate of return is actually the internal rate of return of that project. That is the return that the project itself is generating. If it generates that, if you use that discount rate, NPV will be equal to zero. That is the exact rate of return of that project. But see, we can then compare that rate of return of that project to the cost of capital of the company that we are talking about. If my cost of capital is 10% and the project I want to undertake gives an IRR of 20%, it tells me that that project is generating more than my cost of capital. So it helps me to decide whether I want to. So we are not talking about NPV now because you are confusing yourself by using this thinking. You are still thinking back at NPV as if NPV is giving you zero, and so it's not a positive NPV thing. No, we are saying when NPV is zero, a discount factor that gives NPV zero is the return of the project. Technically, the return that project is giving you. So I can then compare the return of the project to the cost of capital of my own business to know whether I will be able to go ahead with it. Somebody is saying the best solution is anyone that disturbs the class should be removed. They should go to join the YouTube class. Don't worry, we'll forgive them for now until they do it again. Let's forgive them. I think they didn't do it intentionally. All right. So the person that asked the question of NPV, we are talking about two different decision criteria. However, the solution they give most of the time will be similar, but the thinking behind them is slightly different. NPV, I'm using the cost of capital of my company to discount the cash. I'm not interested in I'm not looking at the internal return that the project itself is generating. I'm just saying my company requires a return of 10% on every project. If I use 10% to discount the cash flows of this particular project, will it be positive? If it is positive, I'm fine. But the second method, IRR is saying, I want to determine the internal return, technically the actual return that the project is generating. So we are addressing the problem from two perspectives. Point one, I'm not interested in the return of the project. I'm saying my own cost of capital is this. I want to check if I discount this project with my cost of capital, will it give me positive NPV? If it gives me, that means it has yielded more than my cost of capital. I will accept the project. The second question IRR is saying, look, let me first determine the return of that project. And the return of that project is that point at which NPV is zero. That discount rate that makes NPV zero is the return of the project. Once I can determine that, I can easily then compare that return of the project to my own cost of capital and take a decision on whether I want to accept the project or not. So we are looking at the same problem from slightly different perspective. So once I've gotten this for the project, 5% gives me plus 219.6 MPV, 20% gives me minus 152.6 MPV. So solve and confirm this second point. Again, that's part of the practice. You will now apply this formula. That formula in red is the linear interpolation formula, which says lower discount factor plus, then you put it into bracket, higher discount factor minus lower discount factor. We are talking about 20% and 10%. Those are the discount factor. Multiply by into bracket. So these two are being multiplied together. Positive MPV, that is the positive MPV 219.6, divided by MPV1 plus MPV2. That is those positive and negative, these two MPVs, you add them together while neglecting the signs. When you are adding the two MPV together here, forget about the sign. Just add the absolute value together. That's what you use to divide. So in this case, lower discount factor is 5%. No problem with that. It's here. Plus higher discount factor is 20%. That's why you have 20% here. Minus lower discount factor, which is 5%, is here. Everything in bracket. Multiply by, I'm now multiplying by, what is the positive MPV here? 219.6. 219.6 divided by absolute difference between this and this. So I'm adding two of them together. 219.6 plus 152.6 added together gives me 372.2. Don't forget, this is a mistake people make. Don't you look at the signs. The signs are irrelevant in determining this 372.2, and I will explain why with the number line just now, as I will explain. So let's finish it first. 5% plus 15% multiplied by, when you solve this together, you get 0.59. Everything gives me 13.85. So internal rate of return of this project is 13.85. So the question, why is it that we neglected the sign when we are looking at the absolute difference between MPV1 and MPV2? If you remember your mathematics well, look at this. This is the number line. If this is 0, on this side, you have the positive numbers. On this side, you have the negative numbers. What I'm trying to determine is, what's the distance between here and here? When I'm determining the distance between here and here, it's not the sign that is important. I'm moving from 152 here. I have to move 152 from here to 0. And then I have to move from here to 219. The length between here and here is the addition of 290.6 plus 152.6 without looking at the sign, whether it is positive or negative axis. I'm looking at the absolute length between this line and this line, this point and this point. That's why we got 372.9, because we are doing a linear interpolation of this situation. All right. So that is internal rate of return. Questions, comments? Everybody's fine. Okay.
Hello,
So
sir.
yes. Yeah.
Okay, so please, just kindly go back to the previous slide.
Yeah.
I'm a bit confused. Now, the first discount factor that was used was 5% to get the positive NPV, and then the second discount factor is 20% to get a negative NPV. So my question is that what, in a situation where you are not able to guess, because we're using a trial and error method, in a situation where you're not able to guess the exact discount factor to give you the appropriate internal rate of return, what do you do? Because looking at it, there's a big gap between 5 and 20. So ordinarily, somebody may just want to consider using a 10%. So, and may not, it may not cross one's mind to, jump as high as 20%. So I just want to understand the underlying factor in determining in guessing the appropriate discount factor to use to calculate an IRR.
I got your question excellently well. Now, the first point that you start with, typically, I would just start with something like 10%. That's what I do. I just start with 10%. Experience will help you later to know what to do to make it faster. So if you start with 10%, it will definitely give you either positive or negative. That's the starting point. So it will give you negative or positive. Let us assume that it gives me positive NPV. That is telling me that for me to get negative, I must raise the discount factor higher. I can't go lower. If I go to 7%, it will still be positive and even a bigger positive figure. If I get to 2%, it will be positive and then a far, far bigger positive. So when I get a positive NPV at 10%, I know that I must raise this discount rate high for me to get a negative NPV. So I can say I want to, from experience, you will know after a while, how large is that positive that I got with the 10% will tell me whether I should go and take 15%. If I get a large figure relative to the cash flows scenario at 10%, I know that I will likely not, with 15%, I will still not get a negative number. So I can raise it a bit higher to 20% or 25%. But that is what you learn by experience. That's what I'm saying. So there is no particular guideline. You get to know after you get familiar with the way this thing is done. Because the risk is if you are doing that in an exam, you don't make it too close, because it may take you a long time before you now get a negative. So let's assume you take 15, it's still positive. You take 20, it's still positive. Look at the time you are wasting. And the examiner doesn't know what you are doing. I'm saying. So why not go to 25? Now, when the gap is wide between 5 and 20, for instance, you are correct. The level of precision is lost. A little bit of precision is lost. But that's not too important, because if I'm testing this, for instance, I just want to know that you know what you are doing, not that you are absolutely accurate about it. So don't be afraid to raise it to a reasonable level. While you are not doing a lot of trial and error. If you are in the exam, you have to do 3 or 4 before you now get a negative. I wasted a lot of time. Why are you doing that when you can easily just go to 20% and get your answer, and you still get your answer, because the examiner is just trying to know how much you know. And then this day and age, honestly, we don't test this. This is not our focus of what we are testing. I would easily allow you to use your calculator to get this. It's the interpretation that I'm more interested in. But I do all of this because it also helps you to appreciate what we are trying to get. So for instance, you must raise discount factor higher if you are going to get a negative NPV. It's teaching you something. Now, when the cost of capital is higher, how will it affect the cash flow of the project? Those intuitive things are the ones we are trying to teach by doing these manual things. So otherwise, really, your calculator will give you the answer, your Excel will give you the answer, and all of that. So you get to learn it better as you gain experience. But you can start with something like 10% on average, is a general guide. Then you now decide if from at 10% you got a negative number, what should you do? You go to a lower number if you are going to go to get a positive NPV. So if I do 10% and I have minus 1,000, for instance, then I know I must go down to maybe 5% or 7% for me to get a positive number. So if your 10% at the beginning gives a very low NPV, that means you're already close to IRR. So when you are raising, you don't need to raise too high because you are already close to the IRR when you have a figure that is very slow, whether positive or negative or very close to zero. You're already getting close to IRR. So when you are raising either up or down, you don't need to raise too high again because you are close to the figure. I hope I answered the question. That's the problem with trial and error. Nobody knows it itself. They are just trying it. I hope I answered your question.
Yes, very well. Thank you very much.
All right, thanks. So please, more than anything else, practice. Even with this example we got, when you get to just get the cash flow pattern and then say, I want to determine the IRR by myself. Use a different discount rate. Start with 10% and then go to 15% and see what it does. And use the formula to calculate. By the time you do 2 examples of this, you will have mastered the way this is done practically. All right. So the first 2 critical models we have talked about, this third one is also very, very important. The payback period.
I raised my hand.
I didn't see your hand.
Can you hear me?
I can hear you, but I didn't see your hand. You didn't raise it. Oh, okay, I've seen it. Oh, yeah,
yes, sir.
Sorry,
good afternoon,
sorry,
sir.
I missed that.
Okay, sir. Please, in this trial and error method, are you trying to say that if we decide to use any rate, like in this example, we have 5 and 20, and for my own end, I decided to use like 10 and 25 thereabouts, am I still going to get the same IRR?
You must be very close. You will definitely be very close. It's not going to be precisely exactly the same thing, but you will be very close.
Okay. Then secondly, you talked about using that we don't have to know the discount rate before we can get the rate of return thereabout. So I was listening to hear more on that we don't have to know the discount rate before we can calculate something. There was something you said about that.
Yeah, what I was saying is that for IRR, you don't need to know the cost of capital of the company before you can determine IRR. In this case now, we didn't even refer to the cost of capital of the company, right? We didn't. So we just picked 5% and it gave us a positive NPV. We picked 20%, it gave us a negative NPV, and we calculated the IRR of that project. So if I'm looking at a particular company now, I want to relate this result to a company, I will ask that company XYZ, what is your cost of capital? This project that we want to undertake gives me an internal rate of return of 13.85. So what is your own cost of capital in your company? If the MD says it's 10%, I say, great, this is a good project for you because the IRR is greater than your cost of capital of 10%. So this is a good project for company XYZ. But company ABC, the MD says, my cost of capital is 20%. And I've determined the IRR to be 13.85%. I'll say, company ABC, this is not a good project for you. The internal rate of return, which means the return of this project, is 13.85. But your own cost of capital is 20%. The return cannot cover your cost of capital, so you cannot accept this project. It doesn't fit the profile of your risk or your cost. So reject the project. So I can calculate the IRR without knowing the specific cost of capital of any particular company. The project itself has an internal rate of return, which I'm trying to determine, and that's what we have determined here. And to now know whether a company will accept or reject is a function of what the cost of capital of that particular company is. That's what I was trying to say. I hope.
All right, thank you, sir. Yes.
Yeah.
Well
Right.
gotten.
Thank you. A lot of questions or comments on the chat room. Let me quickly take some of them as we go to payback period. Please, how do you know when to stop when doing the IRR? How to stop what? I don't know what you want to stop when you are doing the IRR. Once you get a positive NPV and then you get a negative NPV, use the IRR. You can, the figures, all of us will use different figures if it was an exam. I can use 10% and 20%. Somebody uses 8% and 25%. Somebody uses 12% and 17%. And we'll still be getting close to the same answer. It's not going to be exactly the same. There'll be a little bit of approximation error, but we'll still get similar results. So there is nowhere to stop. You're not stopping anything. As long as you get a positive NPV at one point, get a negative NPV at another point, apply a formula, you'll get something close to what we got. After getting the NPV, negative and positive, then apply the formula, you get the answer. Exactly. That's what Mr. John said. You start with very low number, like 5 to 10%. This will give positive. Well, this may give positive. Don't always say that. Because there are projects that have IRR of 3%. So if you start with 5 or 10, it will actually give negative from the beginning because the IRR is very low. It's 3%. So, but the likelihood is that if you use 5% or 10% for most projects, you will likely get a positive. Then you shoot up like 25 or 30%, you become negative. Exactly. Thank you, Mr. John. You're already helping me with that answer. So once I get any negative number, yeah, exactly. Once you get any negative answer, you stop. That's all you are looking for. Your negative, the discount factor that gives you your own negative does not have to be my own. There are two different figures. But by the time we get using linear interpolation method, our answer will be very close. Once you get one positive and one negative, you stop searching for discount rate, then apply the formula and you get your answer. Excellent. That's Mr. John. Thank you. All right, so those things are answered. Onyedikachi, your hands are still raised. I hope it's not another question, so you might just drop. Thank you. So let's go to payback period. I think all of us are good here. It's just about now go back and practice what you already know. The payback period is the amount of time or how long it takes for the firm to recover its initial investment. This is what our market women, our parents, our business women do. Okay, if I invest in this project, when will I get my money back? How soon? Will I get my money back within 1 year, within 2 years? Or if you are a trader in the market, will I be able to get my money back in 6 months or 1 year? That's simply what payback period is. It is intuitive. It's not that complex. People use it every day. In fact, it's one of the most commonly used model because you don't need to be a technical finance or accounting person before you understand the concept of the payback period. Now, if the payback period is less than the maximum acceptable payback period, you accept the project. So the question somebody may ask, so what's the maximum acceptable payback period? It is as you define it for yourself or for your company. That's one of the problems with payback period. There is no standard to say this is the acceptable payback period. It is you that will define what is your acceptable payback period based on the amount of time you want to collect your money. If the project's payback period is greater than the maximum acceptable payback period, then you will reject the project. So management determines the maximum acceptable payback period. So if you and I are doing business, you will determine what is your own payback period. I will determine what is my own payback period. So that is the problem. That's one of the challenges, that we don't have an acceptable or agreed payback period. It's a function of you and how long you are willing to allow your money to stay in the business before you are able to collect it back. So similar to all the other models, we always lay out our cash flows in year 0, minus 1,000, year 1, 200, year 2, 300, year 3, 400, year 4, 500. What we do is that we create a third column where you have the accumulated cash flows. So year 0, I have minus 1,000. The accumulated at the end of that period is minus 1,000. In year 1, 200 comes in. Added to the brought forward accumulated will give me 200 plus minus 1,000 will give me minus 800. So at the end of the year 1, I have not paid back. I still have a negative of 800. Year 2, 300 came in. 300 to knock off the minus 800 gives me a minus 500. At the end of year 2, I've still not been able to pay back from that project. Year 3, 400 comes in. Added to the brought forward minus 500, it now gives me minus 100. At the end of the year, I've still not broken even. I have minus 100. But year 4, 500 comes in. Added to the minus 100 gives me a positive 400. So by somewhere between year 3 and at the end of year 3 to year 4, I am able to break even. So approximately you say year 4, but you can calculate it to the nearest month actually. So at this point, there is 1,100 remaining that you need to collect in year 4. Okay, or 500 came in. So you can determine how many months. How do you determine how many months after 3 years? So 3 years plus how many months? You can say 100 over 500. This 100 comes over 500 times a month in a year. Who is helping me with calculator? So I'm trying to see to the exact month. How many months does it take for you to get that money back? So 100 over, it remains 100 that we need to come in the beginning of year 4 to knock off the 100 here. So 100 over 500, we are spreading the amount that comes in over the period multiplied by 12 months.
2.4.
2.4, thank you. So I can say 3 years and 2.4 months or 2 months approximately. 3 years and 2 months. That's what it takes for the project to break even when you calculate it to that detail. Not up to 4, but more than 3. Does it make sense? Does it make sense? All right. So yes. What are the benefits? Yep. Is somebody speaking?
Sir, now I want to ask, because I think I was lost when you were explaining the when they should accept the payback period or not. Now, for instance, let's say the management of the company, their payback period from the question, let's say is 4 years, and this one is 3 years, 2 months. So are we going to accept it or not? What's the decision? Because I missed that part that time, sir.
Of course, if they can tolerate 4 years, that means 3 years, 2 months is even better, right? Because by saying payback period is 4 years means we can tolerate a project that takes us 4 years before it pays back. But this one actually pays back even before the 4 years, so you will accept it. But assuming it is 4.5 years or 5 years, then they will not accept it because they want all their money to come back within 4 years. So once the project gives you something that is less than the defined payback period of that company, it is acceptable. But if it is more, you will not accept it. Okay? Mr. NUR, is that a special Nigerian name? Is it Nuruddin or no?
It's Nuruddin, sir.
Mr. Nuruddin, okay.
Okay. Sir, you said when we want to calculate the exam month, we should divide 100 by 500 and multiply that by 12, right?
Yes.
Hello. But when I did that, sir, I think I got 2.
Yes, I'm answering you.
Yes, sir. I think I got 2.4. I don't know, maybe if I'm the one that made the mistake. When I divided 100,
I also got 2.4.
When I divided 100 by 500, it gave me 0.2. and I multiplied that by 12, and he gave me 2.4.
We agree. That's why we said it is 3 months, 3 years, 2 months.
Oh, okay. So the 2.4 is
you are
for
correct.
these 2. Okay, the 2.4 means
the 2.4 is the months now, number of months.
Okay, thank you.
It's already 3 years is here already.
Okay.
But what we spread it over, we spread this 100 over 12 months. That's like 300, 100 over 500 multiplied by 12 months. So 2.4 months is the remaining period remaining to get that 100. If the 500 comes equally over 12 months, so 100 will have come in 2.4 months. So the payback period is 3 years and 2.4 months. But to make it tidy, you might just round it up and say 3 years, 2 months.
Thank you, sir. I understand.
Okay. Any more questions? Advantages of payback period, very many. Computationally simple, so anybody can think about it and understand it. It is intuitive, easy to understand, and it also focuses on cash flow. We said cash flows are the basis of our decision making in capital budgeting. So it meets all of those criteria. More importantly, because it is simple for everybody to use, and like I mentioned, it's one of the most commonly used model all over the world. Whether you went to school, whether you study finance, whether you're doing it, just makes sense to say, how long does it take for my money to come back when I invest in this project? But it has a couple of disadvantages. One, it does not account properly for the time value of money. If you notice here, we took all the cash flows as if they have the same value. We didn't distinguish between the money that came in for year 4 and the one that came in year 2, as if they are all the same. But in reality, they are not. The one that came in 500 does not have the same value as in terms of weight as the one that comes in year 2 or year 1. So a weakness is that this does not properly account for the time value of money because we are not discounting. Ideally, we should have discounted those cash flows to their present value before we use them. So it doesn't take account of the time value of money. So it's a weakness. It does also not take account of risk. So if you are analyzing 3 projects, we'll just use the same format to analyze them and say, okay, we pick one. What if that one that you pick is riskier than the other 2? There's no way in that our method to account for the level of risk or the riskiness of the different projects. Project will not have the same level of risk. So, but payback is very simplistic. It just takes all of them as if cash flows are the same. The cutoff period is arbitrary. So how do I know when it is cutoff period? Like I mentioned before, it is your own function of your own decision, the function of my own decision, which may not be the same. There's no standard. So it is arbitrary. This does not lead to value maximizing decision. That is true. Because, for example, it neglects cash flow after the payback period. That's a major problem. It can neglect cash flow after the payback. What if one of the projects now brings a lot of big amount after the payback period? We will have rejected the project because it didn't meet your payback period. But year 5, the project brings in $1 billion. You will have thrown it away because you are only looking at the up to the cutoff period. So you neglect after the payback period. So this is an example that shows that ignoring cash flows after the payback period may be a weakness. The payback period for both X and Y, look at these 2 projects. See, year 0, they are the same. Year 1, they are the same. Year 2, year 3, year 3, they are the same. But year 4, this one is bringing in 60. Maybe this is million. And then this is bringing in 0. The likelihood is that from the payback period criteria, assuming 3 years is the payback period for this particular company that is choosing it, it will take project X and Y as equal. Because by the end of year 3, the 2 of them are paid back and they have the same profile. The 2 of them are equal from the perspective of the manager of project of that company. But it is not true. Just wait for 1 more year. This will have given you 60 million. Why this will have given you 0? So this project X definitely looks superior to project Y overall if you consider all the cash flows all through the period. But that method does not do that, and that's a weakness for the payback. So ignoring cash flows after the cash payback period is a weakness for this model. But to address that problem and the problem of time value of money, there's what we now call a little adjustment to the payback period called the discounted payback period. Now, this one now incorporates the concept of the time value of money to the analysis. So the discounted payback period is the length of time it takes for the cumulative discount cash flow to equal the initial outlay, discounted now. So what we do is that we do the same thing, similar to a discount. Instead of just using it like this, we first discount all of this to their present value. And then we then do the cumulative like this. That way, we have incorporated the time value of money in our analysis, which the original payback period method does not do. So what we do is that for this particular case, let's assume that the cost of capital is 10%. So we first discount all of these 1, 2, 3 at 10% discount rate to know their present value. Then we now do another column to have the accumulated cash flows. And we do that and then determine when it actually pays back based on the required payback period of that company. So with that, if you are comparing 3 or 4 projects that have different cash flows coming at different times of the period, we are now bringing them on the same scale, and we are incorporating the importance of the time value of money into our analysis. That is what the discounted payback period is. So let me give you this assignment. Now, all the assignment I'm giving, if you do it and you want me to check with you what you have, I'm willing to do that. But please, as I'm giving you, I want you to try your hands on it. It will help you. So in this example 4, I want you to calculate the discounted payback period, assuming that the discount rate for this company is 10%. Assuming that the discount cost of capital for this company is 10%, and you are using this series of cash flows, what is the discounted payback period for this project? So I've told you what to do. You have the period, you have the cash flow. So discount. So you have the third column that we have the present value of all of those cash flows. So that means all of these are going to be discounted to their present values. And then the fourth column, we then have accumulated cash flows, which we now do the way we have done this one. We can then determine what is the payback period of that project. So I just mentioned this one here. I didn't do an example. I want you to be the one to try your hands on that. So compute the discounted payback period for example 4. I think we said it's example 4. Assuming the company has a cost of capital of 10%. So let's discuss what you get with that. Questions? I think we will soon go on break. Go on a short break. So we have 4 minutes for somebody to ask a question before we go on a short break. 4 minutes. Comments? Class, everybody is too quiet. All that we have done today, if you have any questions, you don't mind to take me back, I would gladly do that. You want to take me back to something I said earlier today? If you don't have, okay. Is Mr. Romanos on this call, or is it Damilola?
Mr. Maran, sir.
Okay, you are here.
Yeah.
Okay, when are we going on break? And for how long?
Yeah, we are expected to go on break by 12:30 for 30 minutes.
12:30 or 12?
12:30. But if you want us to go by 12, no problem.
I think we used to go on 12. You are the one that changed the timetable for yourself. We used to go at 12. I think we should go at 12, you know.
Okay.
It's not, when you stay too long in a class, people lose. So 2 hours is, scientifically, 2 hours is a good time for you to relax a bit. And then, so we break ourselves into sessions so that we can concentrate.
Okay,
so I think we should go at 12.
Well,
and
then we'll come back by 1. That's 1 hour break.
Okay, yeah, we can do our full 1 hour break. Yeah. And then we have, and then the other short break will be shorter, maybe just 30 minutes or less. Yeah. And then we know. Yeah, somebody's raising their hands. Aditola, go ahead. You can unmute and speak.
Yes. Good morning. Please, can you hear me? Yes. Please, I just want to not clear. I need clarity on the IRR. I want to know the difference between that IRR and the discounted rates that we used in NPV when we're calculating NPV. Because I remember you said that if the IRR is greater than the rate of return, the project should be accepted, and if it is lesser, the project should be rejected. So I just want to know the difference between IRR as a whole and then the rate of return in the discounted rates in the NPV, and if there are any correlations. Thank you.
Let me quickly clarify. If the IRR is greater than the cost of capital, so what we used in discounting the cash flows under NPV is the cost of capital or discount rate for a particular company. It is different from one company to the other. So the same project, if 3 different companies are considering that project, they will use different cost of capital because their cost of capital is not the same. One company A may have its own cost of capital purely from equity. The cost of capital will be higher. Another company B may have it as weighted average cost of capital because the company has both equity and debt in capital structure. So that one will be lower because cost of debt is generally lower than cost of equity. When you blend the 2 of them together, it will give you a lower rate. So the cost of capital of company B will be lower than that of company A. Are you getting? So if company C is actually highly geared, maybe it has 80% debt, only 20% equity, the cost of capital will be much lower than the first 2 because debt is generally cheaper than equity. Are you getting what I'm saying? So what we will use in NPV to discount those cash flows for any project will be the cost of capital of the different companies. Now, but that project itself has a rate of return, has something it is generating, irrespective of the company you are talking about. The project, any project has an internal rate of return. That is the IRR. So you can see that they are different. The cost of capital for the different companies is a function of how they got their capital that they are using to run their business. But every project has a return that is bringing, which we call the internal rate of return. So with the NPV, I'm just interested in knowing what project I'm looking at. I'll scan that project with my cost of capital. When I get a positive NPV, I accept. When I get a negative NPV, I reject. But the IRR method is saying, I want to know the return, the internal rate of return of the project itself. When I get the internal rate of return of the project, I can now compare that to my own cost of capital, which is a function of how I got my capital for doing my business to determine whether I will take the project or not. I do hope that answers your question. So
yes, sir. Thank you, sir. Yes, sir. Thank you very much.
Ladies and gentlemen, it's 12 o'clock.
So please let me ask, which is superior when it comes to calculating all this? Which is superior? Is it the NPV or the IRR? When it comes to accepting a project.
Are you in class today? I think I should be asking you.
Sir.
I want somebody in class to answer it because this is something I've emphasized today. So
MPV is the gold standard.
Thank you.
It's the gold standard, but when it comes to
what is saying that when you have
return,
the same IRR and MPV, pick MPV is the gold, not silver, gold standard.
When there's a
thank you. So somebody has bailed me out. That's exactly what I meant. So MPV is superior because of several reasons. It doesn't have the scale problem. It takes account of everything. It takes account of time value of money. So MPV, if you fall into a situation where you have two methods that are giving you conflicting returns, go for the MPV. MPV is superior overall.
Good morning. Is I need to cook.
Ladies and gentlemen, let's come back at 1 and go and take something for break so that we are strengthened for the next set. See you at 1.
Thank you very much, sir.
Thank you.
Yes, let's have a break. 1 o'clock, please. 1 is 1. What is 1 we are starting? Please try as much as possible to log in exactly 1 so that we will delay ourselves. We were supposed to cover more than what we have done right now. We are adjusting at slide 49. Like
so Mar, you can't be heard. You're not heard.
Are you not hearing me? Can you hear me now?
You break and
we can hear you.
fade and you come back.
We can hear you clearly.
We can hear you.
We can hear you clearly.
Okay, sorry for that. You can hear me now, right? Okay, what I'm saying is that we should try as much as possible to return at 1 p.m. exactly, so that we will continue from where we stopped. Because we are actually moving at a very slow pace. We are still at number 49 slides, and we are going over 100 slides today. Let's don't waste our time. Let's try as much as possible to return at 1 p.m. so that we can start exactly 1. Thank you. I do have a great lunch.
Hello, Mr. Mara. I can't hear you.
It's your network. He said you should come back by 1.
By 1, sorry. Sorry for that. But I said you should come up by 1, please, so that we can continue from where we stop. Sorry for
Okay, thank you.
Thank you.
Ladies and gentlemen, by my watch, it is 1 o'clock.
Welcome back, sir.
Are we ready?
We are here, sir.
Thank you. Welcome, everyone. Okay, so let's take it off from where we left off. I'm going to be moving a little faster because we've done some critical things that will help us to move a bit faster. So we were talking about, in the first session, our focus was on capital budgeting, look at quite a number of techniques, the net present value, the payback period, the internal rate of return. We just rounded up the discounted payback period when we went on break. So we quickly round up the session on capital budgeting so we can go to the next major session. But I will quickly mention that apart from those models, we have this accounting rate of return. I just want to mention it. It's not one of the models that we generally use as finance people because of the many weaknesses. But accountants use it, and so let's just mention it. So accounting rate of return can be computed from available accounting data. So we need only profit after tax and depreciation. Accounting rate of return is defined as the average profit after taxes divided by average investment. So you can have that formula here, average net income. Net income is also profit, then average book value. So if for 4 years, we have average profit 200, 300, 400, 500, we just take the simple average, 200, 300, 400, 500 divided by 4, that's the average profit. Average investment is the investment in the beginning and investment at the end. If at the end, this thing has become zero in value, and then at the beginning it was 1,000, 1,000 plus 0 divided by 2 will be 500. So we're talking about 350 divided by 500 to give us 70% accounting rate of return. So we should just know what it is, but like I said, it's not something that we focus on in finance. We are more interested in our net present value, internal rate of return, payback period. So we have this practice question, which we'll quickly look at before we proceed. It tests some of the things we mentioned earlier. So the question is this: Grub Company Management has approved an expenditure of 10,000 naira to evaluate the merits of a project that will require the purchase of a machine costing 300,000 naira and an additional 50,000 to modify and install it at the farm's plant. The machine will be housed in a building that is owned by Grub, but is currently being leased by another firm for storage. The present value of the lease is 60,000 naira, and it can be terminated on short notice at Grub's option. When analyzing the project for capital budgeting, the initial investment outlay for this project is closest to what? So this is testing our concept of relevant and irrelevant cash flows, like we mentioned earlier. So let's have a try at it, 1 minute, and you tell me the option that you are taking, and then we'll quickly use that to discuss relevant and irrelevant cash flows and move on to the next one. Just 1 minute. Try your hands on it. Look at all the figures. Which ones do you think are relevant? Which one do you think are irrelevant? And so what's the initial outlay that will be attributed to this project? Okay, have some hands up. Daniel? Yes? Daniel, you want to speak?
Okay, good afternoon, sir.
Good
For me,
afternoon.
I will go for the 350,000
Okay.
because the 10,000 naira approved on expenditure. That is sunk cost. So therefore, I will not account for that 10,000 naira into the outflow. I will go for the 300,000 to purchase the machine and the additional cost to modify and install it. Because if I go for that, the project will carry on and to yield inflow.
Okay. So you are going for 350?
Yes, sir.
Okay, John. I think John wants to try. Go ahead. Unmute yourself.
Right, I'll go for none of the above because I feel the answer should be 360,000 naira. Because the 10,000 naira that used to evaluate the merit of the project needs to be added. The machine cost, that's 300,000, and the additional 50,000 to modify and install it. So I will go for 360,000 naira.
Okay, an option. Christiana, unmute.
Okay, I'll go for 350, which is option A, because for this, I feel like the expedition cost is irrelevant, and also the present value, because the present value is stating that like when you've done the whole payment and what you get is like your end results of this.
Okay, thank you. Animashaun, I think I'll take one more or two after this and then we'll discuss. What's your own answer?
Yeah. My answer is B, 410, because the 10,000 naira is a expenses to analyze the viability of the project. The 300,000 naira is the cost of the machine, while 50,000 is an additional cost. The property that the machine will be installed in has already been leased at 60,000 naira, which will be factored in as part of the cost for because if that one is not used for the machine installation, the owner, as in the group company, will still be earning 60,000 naira on that property. So therefore, that 60,000 is part of the cost that will be considered. So we now make it 300 plus 50,000 plus 60,000, making 410,000 naira as the initial outlay.
Okay, let's take the last person, Sarah.
All right, sir. I'll go with option A, 350, because like the first person said, 10,000 naira is a sunk cost, while the 350,000 naira are the initial outflow, with 300,000 naira being the initial investment and the 50,000 naira being the cash inflow to install the machine, while the 60,000 naira is the opportunity cost, because the machine is going to be installed in the property where is already being leased out. So that's my contribution, sir.
Okay, so I think we can conclude. Thank you, everybody. I think a lot of people are showing interest in this, but because of our time, we need to move on. Sarah, but you still chose 350, right? You still chose 350
Yes,
as
sir.
your option. But you still
Yes, sir.
mentioned 60,000. What did you do with your 60,000? You threw it away?
The 60,000 naira is the opportunity cost, sir.
So is it not relevant in your analysis?
I don't think it should, because it's not the initial outlay. The question is, what is the initial investment outlay for this project?
Okay. Oh, thank you. I got your point now. So let's quickly take it one by one. 10,000 is sunk cost. I think most of us agree with that. You see, it is to evaluate the merit of the project. Whether you accept the project or you do not accept the project, the company will have spent 10,000 naira. So that 10,000 naira expenditure is not related to the decision to accept the project. Any cost like that is referred to as a sunk cost. So whether the project is accepted or not, the company will have spent 10,000 to evaluate the project. So 10,000 is not just being spent because the company has chosen to implement the project. Assuming the 10,000 will be spent only after a decision has been made that, okay, we'll go ahead with this project. It will now cost us 10,000 to do something. Then it becomes relevant. But for now, whether the project is chosen or the project is not chosen, 10,000 will still have been expended. In that case, it is a sunk cost. It is not based on the decision to accept the project or not to accept the project. So we are all agree. Most of us agree on that first 10,000 naira. 300,000 is the cost of purchase of the machine. That's an explicit cost, very easy for everybody to see. So I don't think nobody missed that one. We all agree that there must be 300,000 naira. But again, if there's additional cost to modify and install the frame, you have to modify it. If you don't modify it, you can't use it for your business. So it's a relevant cost. So again, no argument mostly for 50,000 naira. Then the third one, which is what a couple of people missed, is the company already is leasing a space and collecting 60,000 naira for that lease. Now, the company will stop that lease and install the new machine there for the purpose of doing the business. Is that not a cost? Because if that was not done, there will not have been space. But now that you are going to do that, you will stop collecting the 60,000 lease. So without accepting that project, the company will still have been enjoying its 60,000 renter or lease on that particular space. So that becomes a cost. So if the project is at stake, it's like you have spent the 60,000 to make the project to run. That's the implication. So it is a relevant cost for this because the company is losing 60,000 by just taking the decision to accept the project. It's going to be losing 60,000 naira. Even though this is an implicit cost, you can't see it easily, but you must be careful for implicit costs like this. They are also relevant for the purpose of investment appraisal because you are losing something. If you didn't take that decision, you will still have been getting 60,000. So it's a cost to you to stop receiving 60,000 naira just because you are taking on a new project. So it's a cost of that project. 300 plus 50 plus 60 gives us 410. So this is the way to think about the relevant cost of a project. Okay, good one. This is a self-practice question. Very good question, which I want all of you to try. It summarizes what we did in the NPV and IRR. I'm not going to answer the question now. I'll just give you a little outline to guide you on what to do. I want everybody to practice it, and we'll discuss it when we are doing the final review session. Or if anybody decides to check with me earlier on I'll send you my details. You can check with me based on your own answer. But the question is this, good question. General Motors is considering building a new manufacturing facility in Texas, USA. All permits have been acquired and all laws and regulations have been met. The facility will cost 100 million. That's the initial cost and take 3 years to complete. DM expects to sell enough new vehicles to earn $8 million dollars in net operating cash flow from operating activities. That is after all expenses, including maintenance costs and taxes, are paid each year. So that's the relevant cash flow after we have taken care of all expenses. The facilities are to last for 20 years from the time it is completed. Note that there are first 3 years when it is being prepared. So money was not start coming in those periods. But after money starts coming in, it will come in for 23 years. Take cognizance of all of that in your layout. The question is, should GM proceed with the project? If its weighted average cost of capital is 6%, that weighted average cost of capital is the discount rate or the cost of capital for the company. That is the 6% you will use to discount. Then the question is, what is the internal rate of return of the project? So the project itself has an IRR, which you can determine. Third, assuming the net operating cash flow is now expected to rise by 20%. No, it was 8%, $8 million here. Assuming it rises by 20%, so it will not be higher than this. What happens to the IRR? All other factors remaining constant. So that's another third question that we can answer. This is a practice question, like I mentioned. I will just give you a little bit of a guide. So this is the way to look at it. You can take a long route where you do an outlay for the total number of years. Money flows out in year 1 and year 0, and then year 1, 2, and 3, they are still constructing the plant, so money cannot start. They are not direct preparing. They are not yet manufacturing vehicles the first 3 years, right? Because it will take 3 years to complete. We assume that at the end of 3 years it is completed. Money starts flowing in from year 4, $8 million. Don't forget, this will then happen for 20 years. So that means it takes us to year 23, because cash flow comes in for 20 years from when it starts. So it starts in year 4, it will continue to year 23. So you can do a long outlay for that. And you get your discount factor at, what's the percentage you said? 6%. Discount all the cash flow at 6%. Add everything up, get your NPV. There's a faster method, and I want us to try and apply it, even though we'll still discuss it a bit later. When you use the present value of annuity formula, you see, when a project has the same cash flow, we call it an annuity. You can use a small formula, simple looking formula, to determine the present value of those cash flow will be for a number of length of years. So if somebody give you 100,000 naira from year 1 to year 20, and somebody says, what's the present value of that? You don't need to do this one and calculate 1 over 20 and discount to 20 years. There is this formula that can help you to summarize that thing. Present value of annuity means the cash flow, which is a constant amount, into bracket 1 minus 1 divided by 1 plus r into bracket raised to power n, all in bracket divided by r. That will give you the present value you're looking for. And then you can use that present value against, add the year 0 net cash flow to it to get your final value. So what I've just done, what you can do in this case is, don't forget that from year 0 to year 3, there is no cash flow. So if you use this formula from year 1 to year 23, it has calculated from year 1, 2, 3 up to 23. But don't forget, you want to eliminate year 1 to year 3 out of it, because those are not part of where the cash you have any 8 million naira cash flow. So you can calculate the present value of annuity for 1 to 3 alone. Deduct it from 1 to year 23. Effectively, it has given you from year 4 to year 23. So with this formula, PV of annuity from 1 to 23, which you get here, deduct the one from year 1 to 3. So what you have effectively is from year 4 to 23. Whatever you get here, the net figure there is what you have. Against the year 0 cash outflow, you will then have your net present value. I'm just giving you a tip ahead of the solution, so I won't waste time answering a lot of questions. I see a lot of hands. I presume it is on that question, but my own is, I want you to go and try it. I've given you 2 methods. You can do the long one, go and get the answer with the long one. You do year 1 to year 23, get your answer. But I will then show you how to use the shorter method, and you will discover that I will get the same answer. But I've told you how it is done. By now, I expect that many people in this class should have been able to use this present value of annuity, because it's something that will happen. You need it in fixed income, you need it in what's it called? Corporate finance. But like I said, I'm going to take time to show us this because it's really comprehensive. Maybe in the final revision session, if we have time. So let me just take one question from eBay quickly.
Good afternoon, sir. I just want you to show the last slide just to see the question again.
Oh, okay. 100 million will be the cost initial investment. There will be cash inflow of $8 million from year 4 to 23 or so, because it will continue for 20 years. The discount rate is 6%. So I'm asking for what is the IRR of the project, and then should GM proceed if weighted average cost of capital is 6%. So don't worry, I'll send this to you at the end of today or latest by tomorrow. That's Mr. Romanos. We will ensure that you get the slides. Mr. Nuruddin, let me take your own question quickly.
Okay, sir, sorry for disturbance. Sir, my network broke the last time you were answering the last question. I think the answer was 410, right? You added the 60,000 naira since it's initially a gain for the company and they later have to remove it. So I think you added it to the project, right? And the answer became 410. Because my network was bad then, I did not hear what your answer was. I just
the answer is 410.
Okay,
right,
so
410.
Okay. All right.
Mr. Shepard. Nelly Shepard. You can speak? Okay, you didn't plan to speak. Okay. All right, so I move on.
Good afternoon, sir. So I just wanted to, since there's no cash flow for year 0 to year 1 to 3, what do we use as the cash flow?
0.
So that we can. Okay.
0 now. Once there's no cash flow, it's 0 now. Happy? Thank you. All right. So I move on.
Now end be 23 or 20.
If you count 20 from 4, you will get to 23. Because the cash flow continues for 20 years after it starts, and it starts in year 4. So definitely it must end in year 23. So what the question says doesn't tell you the year it finishes, it tells you how many years. Facilities are able to last for 20 years. So if it is last for 20 years, it just started operations in year 4. So for it to last for 20 years, it must be it must get to year 23 now. Abi? You won't count year 1, 2, 3 when it has not started operations as part of it. eBay. Last question before I move on.
Well, sir, it's not like a question. No, I was able to quickly solve it. I just wanted to know if I can share.
This one?
Yes, sir. First and second part of the question.
Thank you, but I don't want us to solve it here now.
Oh, okay, sir.
I will address that later. So because of our time, I want everybody to try also.
Okay,
so
okay.
some of these things I'm giving are deliberately to make everyone to go and try it, so we can discuss it later and we get it. Thank you.
Thank you, sir.
That's a very efficient one from your end. Deborah, last one.
Okay, sir. Sir, please, I want you to explain that number 3 requirement that we should, assuming that the net operating cash flow is now expected to rise by 20%, what happens to the IRR? All other factors remaining constant. So, sir, how are we going to go about that, sir?
It's a question. It's an assignment, which we will address. I want you to think about it, determine your own answer, and when we discuss it, we will then discuss it. Are you getting the point? It's even, you can answer that question without doing any calculation. So I want you to think about your knowledge of NPV and IRR. Because if the expected cash flow increases by 20%, what do you think should happen to the IRR? If all other factors are. So it's really not, you don't need to calculate anything. So these kind of questions are very common in finance. It shows you understand the mechanics of that technique. So please think about it. We'll discuss it when we get to that point. All right, so let's go to decision making under capital rationing. We've done a good job with NPV, IRR, PVP. If everybody understands what we have done so far, you will not have much problem tracking any question in those areas. So let's go to capital rationing. Now, capital rationing is a issue, I mentioned that before, where you have so many positive NPV projects, but you don't have enough resources to execute all of them. Now, when this happens, you need to ration the available capital in such a way that you maximize the returns that you will get from every ₦1 or $1 invested into any of those projects. So you need to find a way of identifying the best project to start with and the project that is least in terms of what is going to return to you. So because of that, we have this technique called profitability index. Profitability index is a technique you use when you are facing a capital rationing situation. It's close cousin to NPV, but it also has the scale problem that NPV has. So in capital rationing situation, what do? PI is defined as profitability index. The numerator of this formula you will discover is the present value of all positive cash flows. That is the cash inflows. CF1, that's the cash inflow 1, which is assumed to be positive. Cash inflow 2, assumed to be positive. Cash inflow 3, up onto T, divided by 1 plus R. That means we are finding the present value of all of them. So in short, the numerator is the present value of all the cash inflows, divided by the CF subscript 0, that is initial outflow or initial investment. So from our typical formula here, this initial investment of 0 will be the one that will be the denominator. All of these ones from year 1, 2, 3, 3 to 20 will be the positive cash flows. When you discount them and add them together, that will be your numerator here. So what's the decision rule? PI will now give you a figure. When you divide all of that by the initial outlay, you will either get a figure that is greater than 1 or that is less than 1. The decision rule is to accept projects with PI greater than 1. Once this PI is greater than 1, indirectly you are saying the positive cash flows are more than the negative cash that starts at the beginning, which also means that it is a positive NPV project, but it is in terms of the proportion. You want to know what proportion that is. Equal to NPV greater than 0. That's what it means. PV greater than 1 equals NPV greater than 0. So you will rank project. You now rank your project. If you have several projects, you will now rank them. The one that has the higher PI, maybe 1.8. 1.8 is greater than 1.6. 1.6 is greater than 1.3. Even though all of them are positive in terms of PI greater than 1, one is higher than the other. So you can rank those projects on the basis of these, their PIs, that's profitability index, and pick them and allocate funds to them one by one until the available fund is exhausted. That's when you know that you don't have more capital to invest. Now, profitability index also solves the challenge of scale. It does not consider the scale of a project. And let me give an example here. Would you rather invest ₦1 and get back ₦1.50 in 1 year, which is 50% return, or invest $1 million and get 1.2 million in 1 year? That's a 20% return. Which one gives you the absolute better returns? Now, look, this one in terms of percentage return is better. That's when you invest ₦1 and get ₦1.50. But the total value it gives you at the end of the day is just 50 kobo, right? Now you compare that to if I invest 1 million and get 1.2 million, which is 200,000 in absolute value over a period of 1 year, even though it is 20% return. So in absolute value, project 2, even though it is 20%, considers the scale of the project, the scale of the investment. And so my absolute wealth is better when I invest in the second project, even though the return is only 20%, but because of the scale of investment, it increases my wealth. That's what NPV does. NPV looks at the scale of the investment. And that's why we say NPV gives you the best result, because it shows by how much the wealth of the company or the individual has increased, rather than just the percentage returns that you get. So this first one has a higher percentage return, but because the scale is very low, the absolute amount is small compared to the second one. So that's a weakness with profitability index. I still have Deborah's hand raised. Are you asking a question, or is it an error from the last one? Okay, thank you. So this is a good example that we want to look at on profitability index, and it's very important. It's also an important topic that can come out in an exam. So let's be attentive as I take this example. XYZ Corporation has a capital budget of 500,000 to allocate among 3 potential investment projects due to capital rationing. So this company has $500,000. That's the limit of available capital initial outlay. There are 3 potential projects. A, initial investment is 200,000, annual cash flow is 70,000. Project B, initial investment is 300,000, annual cash flow is 90,000. Project C, initial investment 250,000, annual cash flow is 80,000. Each project generates cash flow for 5 years, year 1 to 5. The company's required rate of return is 12%. So the first thing is calculate the profitability index for each project based on what we discussed earlier. 2, determine which project should be undertaken based on the profitability index investment method under capital rationing situation. Then C, what is the NPV of the portfolio after allocating available capital, assuming all projects are divisible? So 3 things. We need to first calculate the profitability index of each project. Good example, because this is an example of annuity, where the annual cash flow is the same amount over a period of 5 years. So I can apply the formula I taught you to calculate the net present value of each project. So we'll do that. We'll do that for each project and discover what their profitability index is. We then rank the 3 projects based on their profitability index, and then we now allocate capital to each of the projects until the 500,000 is exhausted. If you look at it, this 500,000 cannot handle these 3 projects. One is 200,000 required, the other is 300,000, another is 250,000. Even though all of them, as you will see, are positive NPV projects. If we had enough money, we would have accepted all the 3 projects. But because of capital rationing, we don't have enough funds. So that has to be rationed. That's the whole essence of this question. So let's look at it. So what do we do? To calculate profitability index, we need to know the present value of all the cash inflows. So forget year 0 first. I need the numerator of this formula, the one on top. So this one doesn't have the cash outflow. It has only cash flow 1, cash flow 2, cash flow 3, discounted to their present value. So that's what I want to do first. So, but because all of them, now 2 ways you can do it. You can say 70,000 discount factor for year 1, 0.89, 70,000 discount factor for year 2, 0.7977, like the way we learned it before, year 3, year 4, year 5, and then you can calculate that. You will get the present value of the cash flows. Then divided by the initial outlay. Initial outlay for project 1 is 200,000 naira. So whatever we get here, divided by 200,000 naira, we get the profitability index. We can do that for the 3 projects. But I want to teach us this fast method using the present value formulae of annuity. Since 70,000 is constant for 5 years, you can simply use this formula to get what the cash flow will be, the present value of all those positive cash flows. So I want everyone to apply your calculator. This is the formula. This is a very important formula you must know. It will be useful for you in corporate finance. It will be useful for you in fixed income. So CL, that's the cash flow, into bracket 1 minus bigger bracket 1 divided by 1 plus r raised to power n, 1 plus r raised to power n here, close the bracket, then divide all of this second portion by r. It will not affect the 1. So 1 divided by 1 plus R raised to power n, then divided by R. It will give you the present value of all those cash flows for the next 5 years, because N is the number of years, R here is the discount rate, CF here is the cash flow. So let's apply it to the first question, A, which has 70,000 as the cash flow. So 70,000 is the CF here, into bracket 1 minus open bracket 1 divided by 1.12. That should be the, we've been told that the company's required rate of return is 12%. So discount rate is 12% for all of them. So R is 1.12. That's how we got R. Raised to power N. N here for the first one is 5 years. So N raised to power 5. N is 5. That's we'll put 5 there. Divided by 0.12, which is the R. I want everybody to calculate it so that I'm sure that you can get the correct present value. Please use your calculator. What did you get? Who has done it?
The first one, 252,334.
Yeah. Thank you very much. That's Deborah. I'm already, I can know the professors in my class already. Everyone,
I
please
have
use your
yeah. I have 2.61.
2.61. What did you do? I'm asking for the present value of 70,000 naira over 5 years. So.
Yes, over 5 years.
How can you get 2
Unless
points now?
there's something. Okay.
There's something wrong.
There's something wrong. Let me check
Don't
it again.
Your divided by 0.12 will only affect from 1 divided by 1.12. It doesn't affect this one. It doesn't affect the 70,000. No. You are only dividing the second segment with 0.12. So be careful how you use that formula. Okay. Somebody is also raising their hand. Daniel, yes. You can speak, Daniel.
Okay, it's 252,334.
Great. So I'm having witnesses here. I'm having people who are on the same page with me. Any more person who has gotten 252? I want to force us to try this formula now, because you will always find it useful. More attempts. Okay. Another person has gotten 252. That's Emmanuel. Thank you. Well done. So I'm confident that we have, if you have more people who have issues, please ask questions. So Mr. Animashan, you two got it, right? You can speak.
Yes, I got 252. Yeah.
Yeah, that's one of my prof, Abi. Prof. Animashan. One of my profs. Well done. So please, everyone, know how to use this formula. I know what I'm saying. Somewhere along the line, you will need it. So once you have gotten the present value of those cash flows, 252,334.33, then we know the initial outlay of 200,000. You know, the formula for profitability index will now be that PV of cash inflows, 252,334.33, divided by the 200,000. Then it gave us the PI or profitability index of 1.26. That's how we got 1.26 as profitability index. We have 3 projects. We will need to do the same for the 3 of them so that we can know how to rank them and know which project are we going to give the highest amount of money, followed by the next one, followed by the next one until the money, $500,000 gets finished. That's when we can, we will not be able to allocate any more money to any project. That's why we are doing that. So we've done for the first one, we calculated the present value of cash inflows for 5 years. We calculated, we know the initial outlay of 200,000, divided as usual we got 1.26. We go to project 2. That one has annual flow of, I think that's 80,000 or 90,000 this time. That's project 2. The initial outlay is 300,000. So we do the same thing. So if you plug this formula, change this one to 90,000, and for 5 years, at 12%, you will get the present value of the cash flow for 5 years of 324,429.86. Please go and try it and know that you can get this figure. The initial outlay for that project is 300,000 naira. And so the profitability index will be 324,429.86 divided by 300,000 naira. When we do that, we get 1.08. Okay. And then the third one is for the third project. Project C. PV of the cash flow for 5 years, we can get that to 80,000 naira is the annual cash flow for 5 years. Initial outlay 250,000. You do the same thing like this. We get 288,382.1 divided by 250,000 naira. And then the profitability index is 1.15. All right. Are we all on the same page? Are we on the same page, please?
Yes, please.
Yes, sir. Mhm.
Great. So
Well,
that's fine.
I'm trying to get it because I'm not getting it through my. Do I press my calculator anyway?
No problem. You get that one later. You get it later. Just be careful when you put your 70,000 into bracket 1 minus. So the first one you will solve is this segment. You start from here. You can't start from here. You won't get it too. So start from this second one.
Okay.
So when you say 1 divided by 1.12, make sure it is only 1.12 that you raise to power 5. The power 5 does not affect 1. 1 divided by 1.12 raised to power 5. Whatever you get there, divided by 0.12.
Okay.
And you will now deduct it from 1.
Raised to power 5.
Although if you know how to use your calculator, you can even start with the 1. You put the other one in bracket.
Yeah. So then we have to divide by 0.12.
You have to.
Then it's equals to minus 1.
Minus 1. But don't forget, it will give you a negative number. But so you can multiply by minus 1 back to cancel the negative. And then you multiply by 70,000.
Okay, then multiply by 70. Okay. Minus
So
1.
somehow
again.
you get, I know you get that one with a little bit of patience and time.
Yeah.
It's getting better.
Yeah, it's getting better. Win.
Now we have achieved what I wanted to achieve. All the projects have positive PIs, as you can see, greater than 1. So ideally, they are all good projects. But we don't have enough money. This is a capital rationing situation. We need to rank the project in the order of attractiveness. Which one is the most attractive of this project? We will look at the size of the PI. The higher the profitability index, the better. So 1.23 is better, followed by 1.15 before we now talk about 1.08. So we rank it in the next page. So project 8 has a profitability index of 1.26. That's the first project to allocate money to. Project B has 1.08, is the third. Project C has 1.15, is the second in terms of ranking. So we have 500,000 naira. So we keep on tracking our 500,000 naira. I put 200,000 naira here first. All the money available needed by project A, I will give it to it first because it is the most highly ranked project. So 200,000 naira fully accommodated. I go to project 6, which is the second in my ranking. It needs 250,000 naira. So I put 250,000 naira in my allocation fully for what it needs. So I'm taking up project C also completely 100%. So at that stage, I've spent 450,000 naira out of 500,000 naira. What remains is 50,000 naira. But because the project is divisible, that means I don't need to have all the full amount before I can take the project. So I can put 50,000 naira to allocate to project B, which represents 1/6 of the project, because the total amount required by this project is 300,000 naira. But I have 50,000 naira. That means I'm taking 1/6 of that project. The reason I can do that is because I was told that the project is divisible. Assuming that the project is not divisible, I will not be able to do that. I just have to reject the project completely or accept it completely. But because we don't have enough money, assuming it was not divisible, we will have rejected it. But in this case, it is divisible. So I can undertake 1/6 of the project. So this is the way we will allocate our project. So the third part of the answer question says, what will be the net present value of the portfolio after allocating all of this to it? Can we all compute the NPV of the project? Very easy. Abi, we already know the P. We already know this. For instance, project A, the positive cash inflows, the present value of the inflows is 252,334.33, and the initial outlay is 200,000 naira, which is negative. So 252 minus 200,000 will give me the net present value. Here, 324,429 minus 300,000 will give me the net present value. Third one, 288,348. We are just adding together all the present values and the initial outlay to get what the present value will be, which is what I have here. 52,334 for the full project. C is also for the full project. 38,382.10 for the full project, since we are undertaking all of the project, is for project C. After getting the amount we need, 24,429.86, but we are only undertaking 1/6 of it because we are investing 50,000 out of these 300,000 required. So it is only 1/6. So we can only take only 1/6 of also the NPV. So 1/6 of 24,429 is 4,071.64. Adding these three together, will give us the net present value of the new portfolio of assets that we have invested in. Okay. Questions? Comments? Please just go through all that we have done and all what that we are doing. If you have any questions, you feel free to reach out to me or some of your colleagues who have gotten this. I will send you all the materials like I have mentioned. So in terms of popularity and usage of this capital budgeting method, consistency with maximizing owners' wealth, MPV and IRR are the preferred methods. They take account of the time value of money, they take account of the riskiness of the project, they use cash flows, they are technically sound in terms of theoretical capital appraisal methods. So larger companies tend to prefer MPV and IRR over the payback period. Don't forget, those larger companies have the experts, finance people like you, who are there to do the analysis for them. So they tend to prefer the MPV and IRR. They are technically sound, theoretically sound. However, the payback period is still very popular despite its failings and challenges, especially among small businesses and people who are not technically savvy. The MPV is the estimated added value from investing in the project. Therefore, this added value should be reflected in company stock price. So a company grows by the amount of the MPV. The MPV is simply the amount by which the wealth of the company increases when a new project is undertaken. So if you calculate the MPV of the project and the project has 2 billion positive NPV. If a company accepts that project, the value of that company will grow by that 2 billion. That's the implication of an NPV, because it takes account of the absolute value of the investment and the additional wealth created for the company. So, like we talked about, NPV is the gold standard. Take it before any other, if there are conflicts, but other have their own usefulness as well. Okay. All right. So I want us to move to capital structure. Capital structure decisions. Now, this topic is useful in various dimensions, as we will see as we go along. The capital structure is useful for so many things. Every company needs to determine what structure they will use. Do they want to? Capital structure simply means how the firm finances its operations. Is it going to be fully equity financed? Is it going to be financed by debt? Or is it going to be a mix of equities and debt? Most companies use a mix of equity and debt. So there is some level of gearing or leverage in the capital structure of most companies. Debts come in the form of bonds or long-term notes issued by a company. Equity refers to ordinary shares, preference shares, or retained earnings in the company. Sometimes when we talk about capital structure, we also mention short-term debt, so that working capital requirement and so on. But usually, when we do proper analysis of capital structure, we are thinking more in terms of the longer-term funding sources. Now, one thing that is useful, one of the reasons why we consider the capital structure is in determining the cost of capital. What does it cost the company? How much does the capital of the company cost? So when we were doing our capital budgeting just now, I've been talking about the discount rate, the discount factor, the cost of funds, cost of capital for every company. Each company determines that. We have assumed it when we did capital budgeting, but we are looking at how do we even calculate that now when we are looking at cost of capital. So the 3 segments of this is, we want to determine what is the cost of equity. There are models used to determine that. We'll quickly look at that. How do you determine the cost of debt or preference stock? Models for that and approaches to calculate that, we do that. And then how do we determine the weighted average cost of capital, which is what is relevant for most companies because they are usually financed by a mixture of equity and debt or preference shares. And then we'll quickly discuss the concept of divisional and project cost of capital, because there are sometimes a company, sorry, I'm getting an interference from some of you, Mr. Ganyu, Mr. Namdi. Can you mute your devices? So divisional and project cost of capital becomes critical. How do you determine what cost of capital you use if you have a particular project which may not even be consistent in terms of risk with your existing operations? That's what we are talking about here. We'll briefly look at that concept before we move on. So why is cost of capital important? Now, the returns earned on assets depend on the risk of those assets. Return to an investor is the same as the cost to the company. So another way to look at the cost of capital is the return to an investor. But what it costs the company is what the other investor collects as return on the other end. So every investor expects some returns from its investment. That becomes a cost to the company. So equity holders have an expectation of the returns that they must be given for investing in a company. That return is a cost to the company because the company has to take it out of its own available funding or profit to give it to the shareholders. The same thing with debt. So cost of capital provides us with an indication of how the market views the risk of our asset. That's another way to look at it. So cost of capital is also a measure of that because the riskier the asset of the company, the more expensive the cost of capital will become. Knowing the cost of capital is also very useful in determining the required return for capital budgeting purposes, which I've just talked about. So the required return for capital budgeting is that cost of capital, which we will decide. And once we have decided that, that is what is then used to appraise all the capital project. That's why I mentioned earlier in the morning that the cost of capital for company A and company B and company C usually will not be the same because they didn't finance their operation the same way. One decides to use 90% equity, 10% debt. The cost of capital will be different. Another one uses 50-50. Another says I'm only 100% equity finance. All of them have different cost of capital, and to be reflected in what they will compute as their own weighted average cost of capital, which they will then use to appraise all their future projects. So let's look at the three segments of it. Cost of equity. So equity itself as a cost. Equity is the ordinary shares of a company. The cost of equity is the return required by equity investors given the risk of the cash flow from the firm. And we are looking broadly at how do you evaluate the cost of equity. There are two broad approaches: dividend growth model and the CAPM or SML, security market line or capital asset pricing model, which we will look at the two of them quickly. The first one, dividend growth model. How many of us, I'm sure all of us are familiar with dividend growth model. We'll still talk about this a lot in equity valuation when we get there. So we have this formula for valuing the equity of a company, where P subscript 0, that's the price of equity, equals D subscript 0 into bracket 1 plus G. That is the last dividend. The last dividend paid is the D0 into bracket 1 plus G. That makes the next year's dividend, divided by KE minus G, where K subscript E is the cost of equity, where G is the rate of growth of earnings or dividends of that company. So from this formula, if we assume that the stock market is stable and is a true reflection of the value of a company, we can determine what the cost of equity will look like from here. That's the case of is because all of these things are observable. For instance, as of today, I can look at the stock market and say, what is the price of Zenith Bank? So I have P subscript 0. I can determine what the dividend paid last by Zenith Bank was, which is D subscript 0. At what rate is the dividend and earnings of Zenith Bank growing? I can calculate that and get my G. So I'm looking for cost of equity. So what's the correct cost of equity of Zenith Bank? I just make K subscript E the subject of the formula, plug in all those variables that I just discovered, and I will calculate for you what should be the cost of equity of Zenith Bank or any other company for that matter. So make KE the subject of the formula from here, which is what I have done here. K subscript equals DI over PO into bracket everything plus G. So I just derived that from the dividend growth model of of valuing equity. I believe all of us are familiar with that. So we take an example from this question. The stock price of BCE Limited is 19.70 per share today. So we can observe in the market that the stock price of the company is 19.7 Naira. Dividend is paid annually. The next dividend is 2.50. So that's next year's dividend already calculated for. That's DO into bracket 1 plus G already 1 year from now. Expected dividend growth rate is 5% per annum. So G is 5%, 0.05. What is the cost of equity for BCE? So like I said, make K subscript E the subject of the formula. Then you then have equals this subscript 0 into bracket 1 plus G over PO, everything plus G. Or this subscript 0 into bracket 1 plus G, you can call it D1. So when you do this, these two are saying the same thing. D0, 1 plus G, or D1, they are the two of them are the same. They mean next year's dividend. So in this case, we have D1, 2.5, divided by 19.7, that's PO, plus 5%, which is G, 0.1269 plus 0.05 gives us 17.69. The cost of equity for that company, BCE Limited, is 17.69%. Okay. I mentioned this briefly, and I just want us to look at it. How do you determine G? Rate of growth of earnings or rate of growth of dividend? There are two methods. Let me just mention it here. Maybe it will help somebody. One, you can use this formula. V equals ROE multiplied by B. ROE has return on equity. B is the retention ratio of that company. Retention ratio means how much of your earning per share do you retain in the business. Retention ratio is 1 minus payout ratio. So if you consider both your earnings per share to be 1, and you pay out 60% of that in terms of dividend payout, how much do you retain? You are retaining 40%. Because payout and retention should be equal to 100% or 1. So whatever proportion you pay out, the balance of it minus 1 will be the amount you are retaining. So in this case, 40% retention will mean 60% payout. So I just use this as an example to determine how to multiply. So if you know the return on equity for a company, you know the retention ratio, multiply the two of them together, it will give you the figure for yield. Case 2, you can use the streams of dividend of a company for a number of years, 4 years, 5 years, to determine what is the rate of growth of dividend. So if a company in 2019 paid dividend of 3 naira, 2020 paid a dividend of 3.2, 2021 paid a dividend of 3.5, in 2022 paid a dividend of 3.8, and you are in 2023, you want to determine the rate of growth of dividend. You can use this formula to determine it. Where this is saying 3 is what you paid in 2019 into bracket 1 plus G. That G, we don't know what it is, we are looking for it. Raised to power 3 in terms of from 2019 to 2023 is growing at a particular rate, which I don't know, but I'm trying to find. That's why I said 1 plus G raised to power 3. That G, if I raise to power 3, it now give me at 2022 3.8. That means if I compound this 3 naira for at the rate of G for 3 years, by 2022, it gives me 3.8. That's what I'm just saying here. So what is that G that will ensure that my 3 naira in 2019 has grown to 3 naira 8 kobo in 2022? So if I make G the subject of the formula again, I can then calculate and determine what G would look like. So this is what I've done in this example. 2020, 2021, 2020, 23, 24, 2 naira, 2.5, 2.9, 3.2, 3.9. So I say 2, that's what the dividend is in 2020 into bracket 1 plus G. G is what I'm looking for. It in this case, raised to power 4, because 2020 to 2021 is 1, 21 to 22, 2, 22 to 23, 3, 23 to 24, 4. So if you have 5 streams, your number of n will be 5 minus 1. That's why it is 4 here. It depends on you remove, and if it is 6 that are here, 6 minus 1 will be 5. So your power that you'll be using will be 5 here. Because you are saying from 2020 to 2021 will be 1 year. 21 to 22 is the 1 year. 22 to 23 is 1 year. 23 to 20. That's why this is 4. So 2 into bracket 1 plus G raised to power 4 equals 3.9. That's what you get in 2024. So using your mathematical knowledge to find G, 1 plus G raised to power 4 equals 3.9 divided by 2. That's the 2 here, dividing both sides by 2. 1 plus G raised to power 4 multiplied by 1 over 4 equals 3.9 over 2 multiplied by 1 over 4 in terms of power. Because I want to eliminate the power from here so I can get my G. So 4 times 1 over 4 will cancel out to 1. 1 plus G equals, I simplify this using my calculator, I get 1.182. G therefore is 1.182 minus 1, which is 18.2%. So the rate of growth of dividend for this company that I've given this example is 18.2%. So you can use that one to estimate your G. You can use this other one to estimate your G, depending on what is available for you in a question or in a practical scenario. So just to talk about how to get your G, which is very important. Okay, so that's model one, how to find the cost of equity of a company. Second model, maybe even more popular, is the capital asset pricing model. The capital asset pricing model formula is given here. Expected return on an asset equals risk-free rate plus beta into bracket return on the market minus the risk-free rate. Usually the risk-free rate, we use treasury security as a precursor for the risk-free rate. So in Nigeria today, we use what is the rate of return on treasury bill or treasury bond as a precursor for risk-free rate. Then RM will be what's the return on the market as a whole, the securities market. Beta is the systematic risk of that particular security that we are dealing with, and that's the expected return. So we should all be familiar with the capital asset pricing model now. I don't know, I think I have an example here in front. Okay. All of us are familiar with capital asset pricing model and how to use that one to determine the cost of equity. Okay. I think this I just mentioned this one so that you know the relationship between correlation, covariance, and beta and all of that. Not too serious. You should be familiar with that from your portfolio management. But let me mention this point, very important. The distinction between asset beta and equity beta. Now, asset beta is the beta of the asset of the firm, irrespective of the sources of financing of that business. While equity beta is the volatility of the return of a stock, taking into account the impact of the company's leverage from its capital structure. So the nature of an asset of a business in itself, irrespective of the financing sources, is determined by the asset beta. But it can be, the beta will be more volatile if the company is highly geared. So if the company has more debt, or depending on the kind of gearing the company has, so that can affect the equity beta. So you should be able to move from equity beta to asset beta. Most of the time, what we use for our analysis is the equity beta of the firm. So you know the asset beta and you know the financing structure of the company, you should be able to calculate the equity beta of that company from here. So equity beta equals asset beta into bracket 1 plus G over E. DEI is the debt over equity in terms of the proportion of debt to equity into bracket 1 minus tax rate to give us the equity beta. So I think there's an example here where we have Mr. A analyzes a stock whose unlevered beta. Unlevered beta is the asset beta, is 1.5. Debt to equity ratio is 40%. Tax rate is 30%. Calculate the levered beta. Levered beta is the equity beta. So please, anywhere you find levered beta, we are talking about equity beta. Anywhere you find unlevered beta, you are talking about asset beta. So the distinction between asset beta, equity beta, and how to move from one to the other is very important. Please go and learn this concept. So in this example, asset beta is 1.5. Debt to equity ratio is 40%. Tax rate is 30%. We just plug in that formula I just showed us now. Equity beta equals asset beta. Asset beta is 1.5. 1 into plus D over E. D over E is 0.4, as we have mentioned, multiplied by 1 minus tax rate. Tax rate is 30%. So 1 minus 3 bracket. 0.4 into bracket 1 minus 0.3 plus 1 multiplied by 1.5 gives us 1.92. Usually you will discover that the equity beta will be higher than the asset beta because with the higher, with the financing structure, especially gearing, debt being in the capital structure, the volatility of the returns will be higher. And so equity beta will typically be higher than the asset beta. Third point, this is important for analysis reasons. What do you do when a company is financing a project and you need another form of funding for it? What is the cost of capital you will use for analyzing that project? If the level of riskiness of that new project is different from the normal risk of the asset of the company. So a project may have different betas. When the project and the firm are not in the same line of business, use industry beta of the project. Now, when the project risk is inherently different from that of the normal operations of the business, even if it is the same industry, you need to estimate the individual project's beta because the level of risk of that project is different. And in our appraisal, you need to consider the riskiness of the project that we've been saying. So in that situation, estimate the individual project beta. If the project's risk is higher than the firm's risk, the project beta should be used because the risk level is higher and you need to factor that into your analysis. If the project beta is lower than the firm's risk, the project beta should also be used. Why? Because the project is not as risky as the normal asset. So if you are not careful, you may be rejecting good projects because you are estimating them at a higher level of risk. Indeed, they are not as risky as the normal operations of the business. So use the project-specific beta once the risk of a project is not similar to the normal operations of a business. Otherwise, you say two errors may occur. You may accept too many high-risk projects, or you may reject too many low-risk projects. So in that case, it is not good for the company. So to maximize the opportunity of a company, you need to be careful. Use the appropriate data for the purpose of analyzing the company. Somebody wants to ask a question?
Yes, sir. Good afternoon, sir. So you're saying...
How are you?
I'm very well, thank you. So you're saying in any case, whether the project's risk is higher or lower than the firm's risk, the project risk beta should be used?
Yes.
Okay, thank you, sir.
Okay. So the most important thing I'm saying is that whether higher or lower, once the riskiness of the project is different from that of the normal operations of the business, you should use the project-specific beta. Okay, Informa, are you still the same? I think your hands are still raised. Okay. So, regarding capital asset pricing model, beta has some weaknesses. We've been talking about the concept of beta. Beta is calculated using historical figures. So a lot of analysts, a lot of experts are saying, you are trying to predict what will happen in the future. So can you really depend on beta, which is historical? And that's why you want to use beta that is not too far away. You don't want to use historical data too far away to calculate your beta, even if you are calculating beta. So investors are much more interested in what happens in the future, and the future is dynamic. What happens in the future may not correlate with what happened in the past. So that's one weakness of beta. A stock level of volatility may change over time, and that's why I said beta is dynamic. As circumstances changes, beta may then be less practical for the purpose of evaluating project. Beta also ignores company fundamentals. Risk levels can change dramatically depending on business strategy. So if the risk level changes, whatever project discount rate you want to use should reflect that. So beta sometimes does not incorporate that. For example, a formerly low beta company can overextend itself by borrowing heavily to fund expansion, and therefore it becomes more risky. And the market may not know that. Or it might acquire a firm on a new sector to gain its foothold, which is even more risky than what it had before. So if you are using the historical beta, you will not have incorporated the higher level of risk that the company is now undertaking. So that's it. So those are some of the weaknesses of beta. So good. We have a good example of how to calculate beta, the cost of equity using beta. And it says the risk-free rate and the expected market return are 0.06 and 0.12. I hope everybody knows that this is the same thing as 6% and 12% respectively. So I could say 0.06, that's 6%, is 12%. Okay. According to the capital asset pricing model, the expected rate of return on security X with a beta of 1.2 is equal to 2. So is to what? So we are saying if you have these variables, you have the return on the market, you have the risk-free rate, I should be able to compute the cost of equity of a company. So in this case, plug it in, RF risk-free 6% plus beta 1.2 into bracket 12% minus 6%. That's return on the market minus the risk-free rate. In this example, it gives me a figure of 13.2%. That is the beta of the company, the rate of return of the company. Okay. So that's how to use beta for our calculation of. So this is a past question. Simple questions like this do come out, and then you simply pick your answer and smile on. Another example, quickly, a mature company XYZ Limited recently paid a dividend of 3 naira per share. So when they say recently paid a dividend, that means we are talking about D subscript 0 dividend just paid, not next year dividend. The company is expected to grow at a rate of 5% per year, so G is 5%. Company's required rate of return is 9%. KE is 9%. The risk-free rate of return is 3%. Calculate the current value of the share of a company. Current value of the share of a company, that's price of the company. P subscript 0 equal D subscript 0 into bracket 1 plus G divided by KE minus G. P subscript 0 equal D0, that's 3, that's the current dividend, into bracket 1.05 is growing at 5%. So 1 plus G, that's 1.05. Everything divided by 0.09 minus 0.05. So that gives me 78.75. That is how to use beta and the related concept to determine the cost of capital and the value of a security. These are straightforward for everybody, I'm sure. You are just practicing what we are familiar with. So cost of equity, that's how we determine cost of equity. So how do you determine cost of debt individually? The cost of debt is the required return on the company's debt. So when a company borrows money, has bonds in the market, for instance, and so on, you can determine what is the cost of that debt to the company. We usually focus on cost of long-term debt or bonds, typically, not on short-term. And then the method, there are two critical methods. One, the yield to maturity on existing debt. So when you know the debt of a company, you can compute the YTM, yield to maturity of debt. I'm sure you have dealt with that in fixed income analysis, although we'll still talk about that briefly before I move on. The second method is to estimate the current rate based on the bond rating expected on new debt. So those are two methods. Bond rating expectation on new debt. So there is a way in more developed markets, they come with these bond ratings. And based on the ratings of bond debt, the spread expected on the bond, depending on the level of risk it has, is used to determine the cost of debt. Don't forget that the cost of debt is not the coupon rate on the company. The coupon rate just tells you how much the coupon rate on the how much it helps you to calculate how much will be the bond interest to be paid on the bond. Is not the same thing as the cost of debt, unless your coupon rate is equal to the yield to maturity. That's when the two of them will be the same. But technically, what is the cost of debt? Cost of debt is the yield to maturity, like I mentioned. And what is yield to maturity? The yield to maturity of a bond is the internal rate of return of the bond. That is why I took time for us to understand the internal rate of return on the bond. So if you have a bond that has coupon rate of 10%, maturity is 3 years, the price of the bond is 105, the par value on the bond is 100, and then we are asked to calculate the yield to maturity of the bond. What we are being asked to compute is simply the internal rate of return of the bond. We have spent quite some time calculating the internal rate of return in that first class. So let's apply it to bond. Here, cash flow, I want to use different levels to determine. I need a positive NPV, I need a negative NPV, so I need two discount rates. In this example, I'm taking 8% and 5% for the purpose of this class. So what are the cash flows? Price of the bond, that is the initial outlay. 0 is coming in year 0, negative 105. Everybody's familiar with that. In year 1, what cash flows will come to the bond owner? 10% of the par value. 10% of 100 is 10. That's how we got this. So there will be interest of 10% paid to the owner. Year 2, the same thing. 10% of 100, 10. Year 3 will be the final year. It will mature. The principal par value of 100 will be repaid back, and the interest of 10% on that will also be paid back. 10% on 100 is 10, plus the coupon for the principal amount that will be paid back. 100 plus 10 gives me 110. That's how I discovered that this will be 110. 10, 10, 110. Now with this, I can use 8% to discount these cash flows and see whether I get a positive NPV. I can also use 15% to discount. One should give me positive, one should give me negative. I think I've done it. I can't even remember now. I think I've done it, and 8% gives me positive, something gives me negative, and then I can compute the IRR. But it's an exercise. Go and try it. Use 8%, use 10%, and then you can use our linear interpolation method to determine the IRR. That IRR is the same thing as the yield to maturity of the bond, is the same thing as the cost of debt for that particular bond. I think, yes. I have a shortcut method. Incidentally, it was one of your colleagues that gave me one of these classes some time ago, there were 2 days ago. And I found out that it worked well. So this is a shortcut formula for yield to maturity of a bond. C plus F minus P, bracket, divided by N, everything divided by F plus P into bracket divided by 2, where C is the coupon, F is the face value of the bond, P is the current market price of the bond, N is the years to maturity. So I think we applied it to this particular bond. This bond has coupon rate of 10%, maturity of 3%, price of 105, par value of 100. And then if you plug it in, C, coupon 10% plus F, face value is 100. P, the current market price is 105. N is 3 years divided by 3. Everything divided by 100, that's still the F, the face value, plus P, that's the current market price, 100 divided by 2. I did my calculation and we got 8.13%. So I'm saying this should be the IRR of the bond. And in our example, if you did it and try it, you discover that you get something very similar, very close to what we have gotten. But maybe I will change this one to a smaller figure. Maybe I will say 5% here. Since I know that the IRR is about 8%, I want you to actually get a positive number here that is a little bit far away, and then you get a negative figure here. You do your linear interpolation, you must get something close to this figure, 8.13. So I'm re-emphasizing, I've said it and we have said it before, the internal rate of return of a bond is equal to the yield to maturity of that bond. And so it is the way we compute the cost of debt of a company. Company questions? I'm the only one talking in this classroom. Question? You have a class rep in this class.
Doctor, you said you are going to be fast. So that's why we are someone like me is just holding on, because I didn't need to draw you back. If not, I want to draw you back to some of those past solutions you gave us as example.
I pity you now. That's why I came back. You know, I have changed my mind. I wanted to be more gentle.
So, if it's possible for you to slow it a little, then so that we can flow with you, sir, especially me.
All right. That's why I'm doing this.
Okay.
That's why I'm slowing down a bit.
I'm trying to see if I can copy and then practice it. But before you know it, you already jumped to the next page and then next topic. So I get to not follow a flow.
Don't worry. Don't worry. You know what I want us to do? I know that I'm speaking. You may not get 100% of everything, but I'm sure you're getting quite a bit of it, a reasonable portion of it. Since I'm going to give you the materials, you now settle down and do the materials, and I will make myself available to also address. Because if we don't do it like this, we won't finish.
I agree with you.
Mr. Romanos will not give me more time, and he will not give you more time. The man is very strict with his time. The man is very strict with his time. So,
he will not
give
long
you more
as
time.
you give us the material, sir. So long as you give us the material, I'm okay with
definitely.
it.
You get the material. By God's grace, by either tonight or by tomorrow, you should get the materials.
Okay, so we can fly now.
Okay. So, class, if you have a question, I still want to take 1 or 2 questions for 5 minutes before we move on. If I have any. Okay, I think we are doing good. But I can assure you, if you can master all the things we have done today and you can put them into practice, there is hardly, both in your fixed income and corporate finance, you will be well covered substantially in so many areas from what we have done so far. So that's the cost of debt. But overall, cost of debt, by the time you are calculating, the effective cost of debt that you will use will be yield to maturity into bracket 1 minus T because of the after-tax effect of debt. So by the time you are doing things like calculating the cost of the final cost of debt, cost of equity, for weighted average cost of capital purposes, you will then put into bracket 1 minus T because there is a tax shield when you are using debt. So because of that tax shield, what effect is that having on the value of the company? So into bracket 1 minus T. So effectively, cost of debt is what I've highlighted out here for all of us to see. Okay. So we've talked about cost of equity, where we use 2 models. We can use the dividend discounting model, where we now make KE, cost of debt, as the cost of equity as the subject of the formula. That's option 1. Option 2, we use CAPM, capital asset pricing model, where we can calculate what the cost of equity is. And then we come to cost of debt, the most popular method, is when you are calculating the yield to maturity of the bond, which I said is equivalent to the internal rate of return of the bond. And we have seen an example here to illustrate that. I've also given us a shortcut model, shortcut method that you can use if you don't want to go through the long process of calculating using our interpolation method. So let me listen to Deborah. Deborah wants to ask a question. Yes, go ahead. Deborah, go ahead.
Well done, sir. Please, sir, can you just scroll up a little? I want to snap that beta asset, that hub, that formula. I just want to snap something there.
Is it this one?
Yes, I think it's fine. Thank you, sir.
Okay. Don't worry, you get the slides. So you get the slide. All right. I think we've done well. So let's move to the third part of it. Now, the third segment is cost of preference shares. You know, we talk about cost of equity, cost of debt. Preference shares are also an important part of equity for some firms. We don't have a lot of preference shares in Nigeria today. We used to have at some points. Recently, we have not had a lot. And generally, globally, they are not as popular as equity and bonds directly. But they are also an important type of financing, and they can be in the capital structure. Now, preference shares generally pay a constant dividend every period. So the dividend does not increase like you normally have for equity. Dividends are expected to be paid every period forever. So there's a fixed amount, usually forever. Now, the valuation of preference shares is a perpetuity or annuity situation. So we can use the annuity formula, rearrange and solve for RP. That is return on the preference share. Look at the formula I have in front of me. In finance, I'm sure you should be familiar with this. When there is a fixed amount that is receivable forever or for a long period of time, you can use this simple formula. So return on the preference share is this fixed dividend divided by the price of dividend. Or if you want to know the value, the present value of the dividend itself, you can say the price of dividend, the price of that particular preference share equals the dividend divided by the rate of return on that particular thing. So it is a perpetuity situation in finance, which you use this simple formula to solve. So let's take an example and then we'll get it. Example, a preference share is issued for a net price of 42. So the price of the preference share is 42 naira. It pays a dividend of 5 naira annually, and it pays that into perpetuity. So what is the cost of the preference stock? It's simply 5 naira divided by 42, which is 11.9%. So the cost of preference shares is 11.9%. So we have the cost of debt, we have the cost of equity, we have the cost of preference shares. So if this company has all of these methods of financing in its capital structure, we will then need to compute what we call the weighted average cost of capital based on the proportion of each of these capital sources in the capital structure. So what percentage of equity does the company have? What percentage of debt does it have? What percentage of preference shares does it have? And what is the cost of each of these particular classes? Then we can calculate what we call the weighted average cost of capital. And that's what we'll go to see next. So for most companies, like I mentioned, they use different sources of financing. So based on that, there must be different sources, and there must be a weighted average cost of capital. How do we determine that? So we do a weighting like this. Weighted average cost of capital is equity over equity. If there's only equity plus equity and debt, so I'm assuming only equity and equity plus debt here. So we say, what is the amount, the value of equity relative to the total capital? Equity plus debt is the total capital in that business. Equity over equity plus debt multiplied by the cost of equity plus debt over equity plus debt multiplied by the cost of debt. Don't forget, I mentioned before, because of the tax shield effect, you multiply cost of debt by 1 minus T in terms of tax rate. That represents the tax deductibility of interest expense. So because interest expense is tax deductible, we must multiply the last term by 1 minus T. So an example will make it clearer. So a firm wishes to raise 10 million naira using 40% debt, 10% preference stock or preference shares, and 50% ordinary shares or common equity financing. Given the following scenario, calculate the firm's cost of capital. So we know sources of financing. Debt, it is 8% after tax. So that means we have used 1 minus T in determining this 8%. If it is before tax, we will then multiply it into bracket 1 minus T. But because it is after tax, it's already taken account of, so 8%. The weight of debt in the capital structure is 40%, 40 over 100. So it's already done as 0.4. For preference shares, 10% is the cost. The weight of preference shares is 10%, 2.1. Common equity, the cost is 14%. The weight is 50%, 0.5. When you notice this, you discover that total of this must be equal to 1 or 100%. Adetola, can you mute your device? Yeah. So when you add all of this together, it gives you 1. The weight of all of it must be equal to 1 because all of them must be 100%. So this 40%, this 10%, this 50%, 100%. So when you have calculated the different segments, the different sources of finances of the company in terms of their segment, debt, preference shares, equity, you know the cost of each one, and then you know the weight of each one in the capital structure in terms of percentage. You can then calculate the weighted average cost of capital. Weighted average cost of capital will be cost of debt multiplied by weight of debt plus cost of preference shares multiplied by the weight of preference shares plus cost of equity multiplied by the weight of equity. So in this case, 0.4 multiplied by 8% plus 0.1 multiplied by 10% plus 0.5 multiplied by 14%. All of them give us a single figure of 11.2% as the weighted average cost of capital. So for this company, this 11.2% is what we call cost of capital for this company. This is what we use in our capital budgeting appraiser as a discount factor when we are doing MPV. And when we are determining whether we should take a project based on IRR, we compare the internal rate of return of that project against this 11.2% cost of capital for this company. So if the IRR is 20%, the weighted average cost of capital of this company is 11.2%. IRR is far, far higher than cost of capital. We will say for that project, it is acceptable to the company. So this is the cost that I've been talking about in terms of what this company will be using to appraise its own capital budgeting projects. So if there are 3, so in this example, weight of equity, how did we determine value of equity into value of equity plus value of debt plus value of preference shares, because there are now 3 components in this particular example. Weight of debt is value of debt into bracket value of equity plus value of debt plus value of then weight of preference shares, value of preference shares, value of equity, value of debt or value of preference shares. That's how come we got all of this weight of 40%, 10%, and 5%. We calculated the cost of each of them using the different models we used before. Yield to maturity into bracket 1 minus T is what gave us 8%. For the preference shares, we use the formula for perpetuity that we have on the other side. For the common equity, we could have used the Gordon's growth model using KE as the subject of the formula, or we could use the capital asset pricing model to determine what this common cost of equity is. So in all of this, we can then use this together to determine the weighted average cost of capital. So what factors influence the weighted average cost of capital of a company? Number 1, market conditions. So if the interest rate situation in a particular economy is very high, the tax rates in that economy, the market risk premium, all of these factors will
Hello, sir. Please,
determine.
I have a question.
Sorry, who's speaking?
Okay, hi, my name is Shion. Good afternoon, sir.
Good afternoon, Mr. Shion.
So when you're doing cost of capital for a bank, for example, right, do you factor in deposits and cost of deposits as part of the debt structure of the bank?
No, because that is not what the bank is using to finance its own operation. Deposits are meant to be used for on-lending. It's more like working capital for a bank. You collect deposits, you are supposed to lend it out to other companies. So in terms of what the company is using to run its operation itself, to finance its own operation itself, are the equity from the equity holders. And sometimes banks even go and raise debt in the bond market. Some of them, especially international debt, a lot of Nigerian banks have done that, collect money from IFC and all of that. Those are the long-form capital form. In terms of the nature of business of a bank, deposits are not meant to finance the running and operations of the bank. They are simply working capital tools, because as you collect those deposits, you are supposed to lend them out to others and then collect the spread as a return. So technically speaking, the deposits are not part of the sources of financing of the bank. I hope that answers the question.
Okay, thank you.
Thank you.
That's fine. Thank you.
Thank you. So, so market condition is very critical. Look at what is happening in the Nigerian economy now. What has happened in the last 1 year? Rates has gone up in every dimension, and so on and so forth. So if the weighted average cost of capital has gone up, will have gone up for any organization at this point in time. If you want to come to the capital market and raise money, what the market will be demanding for will be high. Your investors are the equity holders are expecting high rate of return for you to compensate them, given the fact that because of the rate of inflation and the rest, even risk-free return based on yield on treasury bills and treasury bonds so high, and then they will need to. That's going to be the baseline for them. They want to add something extra as a premium for risk for them. So at this point in our economy, weighted average cost of capital is going to be very high for any company because of the market condition. The firm's capital structure and dividend dividend policy will also affect it. And then the firm's investment policy. So if a company invests in fairly risky projects, investors will be aware of that. They know that they are taking a high level of risk when they invest in that company, and they will definitely require a higher level of return to compensate them for the higher level of risk they are undertaking. So that will also affect the returns of that company. So the capital structure is also very important. If the capital structure of the company is like it is all 100% equity financed, it's going to be more expensive. Because equity is the most expensive of all the sources of financing. So the WACC of that company will be quite high. Because equity investors require, because they know that they are carrying ultimate risk. If the company collapses, they lose all their money. But if you have debt in your capital structure, the weighted average cost of capital. Hello? I hope you can hear me. Okay.
We can hear you now, but
Yes,
before
we
we
can
cannot
hear
hear you.
Oh, okay. I saw that there was a little bit of, but it should be fine now. So I just mentioned that, I just repeated the 3 major points mentioned here regarding the influences on the weighted average cost of capital. I said market condition, capital structure and dividend policy of the company, firm's investment policy, all of this will affect the WACC. Question: which of the following statements regarding dividend policy is incorrect? So there's a relationship between dividend policy and the capital structure. But let's take this question. A policy of regular cash payout can help to reduce agency problems. So we are looking at what is incorrect here. Is that statement correct? Can we take it one by one and discuss before we move on? A policy of regular cash payout can help reduce agency problems. How does that happen? What does that mean? Can somebody help?
Dividend and interest payments cannot be a regular thing. It has to be at a stated period of time. So paying it out on a regular basis or whatever, it cannot help. It will affect the cash flow of any business. So I feel that policy is not correct, sir.
Please read it carefully. There are 2 operational words: regular cash payout and agency problem. So you need to relate that to agency problem for us to be sure that we are online, right?
Okay. Regular cash payouts.
Agency problems. Yes,
agency.
oh well.
No, the agency, yes. Doctor, how do you mean agency now? What's the rule of the agency here now?
Agency
That's
problem
the question.
usually is, agency problem usually is when managers hire external managers to manage their, maybe shareholders, hire external managers to manage their company for them. So usually regular cash payouts, maybe in form of dividends, is to shareholders and not to external managers, except in the case of performance bonuses. So I don't believe that such policy will reduce agency problem, because cash payouts in this scenario where it is dividend policy is not usually directed towards the agents, which are the managers in this case. So I believe that this policy will not work.
Thank you, Orwell. Daniel. Daniel.
Okay, I believe a policy of regular cash payouts can reduce the risks, can reduce agency problem, which is correct, because depends on the shareholder preference, which receiving cash, regular cash, like regular dividend. A lot of shareholders will prefer cash payout, which to that it's correct. It's a good one. Regular cash payout will not be a problem to them because of their preference. So for me,
but how does that reduce agency problem? He's saying that regular cash payout can help to reduce agency problems.
Yes. Regular cash payout can.
How does it reduce agency problem?
For me, agency problem is when there's a issue between the shareholders and the managers. So when the shareholders are receiving their take home, as usual, it could reduce the problem, the agency problem, that is the issue between the shareholders and the manager.
Okay, thank you.
Yes.
Let me take Emmanuel.
Yeah. In the first instance, there is agency relationship theory, agency theory between the managers and the shareholders, where the shareholders are the principal, while the managers are the agents. And that is why they will prepare their financial at the end of the year and at the AGM to render their stewards to their principals. So regular cash payout in form of dividends reduce the frictions between the managers and reduce the friction between the managers and their principals. So you'll see that when you attend any AGM and there's consistent payment of dividends, you have less issues with your shareholders. So it's a valid one.
Okay, thank you. Ganu, let me take Ganu as the last one because of time. Good contributions from the class. Ganu, you are still here. Quick. We can't hear you. You can unmute yourself. Ganu.
Yes, sir. Good afternoon, sir.
Good afternoon.
Thank you, sir. To my own contribution is that the option A is correct, because if you come from the angle of a regular cash payout, you talk about the dividend payment, regular dividend payment. And then if you talk about agency, reduced agency problem, yes. Agency and the just a principal and the agent, meaning that the manager of the funds and then the investors. I'm very sure that any organization that pays regular dividends, the investors, the shareholders are very happy. So to me, I believe that the option A is correct. It's reduced.
Thank you.
Thank you.
Thank you. Thank you all the people that have contributed. I see more hands, but I think I will take it here. But very good point. I am happy I will raise that. So I noticed that some of us are not too clear about the agency problem. Let me use this opportunity to explain the agency problem a bit. Some of us have mentioned it. Every business, modern businesses, are run by managers on behalf of their principals, the owners of the business. And the agency problem is the fact that there's a tendency, don't forget, the owners of the business are not there running the business. They are away. The managers are running the business. They are the one there day to day. They know what is going on. There's always a possibility, there's always a friction in that managers tend to use the resources of the company to their own benefit, to the detriment of the owners. It's always a problem. So there's something they call empire building. You see some companies where the CEOs are flying private jets, the CEO are buying limousine. It is your money that they are spending. The money that will have come to the owners as dividend at the end of the year, as profit at the end of the year, is what some managers are spending. So there's always that friction. How are you spending our money? What are you using the money for? So if you have a regular policy of paying out cash to shareholders in form of dividend, it will likely reduce the agency problem. Number one, because the amount available as surplus for somebody to waste is reduced. And like some people have said in the course of the discussion, the shareholders are happy. At least they can see every year something consistent is coming to them, rather than somebody just coming to AGM to speak grammar and tomorrow you go and buy limousine. The shareholders have nothing to show for it. 5 years, 10 years, and that happens in some companies in Nigeria. So this will likely reduce agency problem, that friction between owners of the business and the managers of the business. So that question one makes a lot of sense that it will be correct. Let me quickly take the other ones before we go. Financial market with lower transaction costs will generally be expected to have higher dividend payout. Is that correct? When there is lower transaction costs in the capital market, do you expect higher dividend payout or not? Yes, it's most likely, because when you pay dividend, and the transaction cost is low, and tax and all the rest, everything to do with transaction cost, a large chunk of that money goes effectively to the shareholders. And so there will be an incentive to pay higher. In companies, one of the methods, one of the things that companies do is that when they see that the cost of transactions are too high, they will find another way of giving benefit to their shareholder rather than dividend. Because if tax and other things are going to carry away a lot of the money, it's a waste. So sometimes you see people trying to ensure that you get capital appreciation rather than dividend, because the cost, the tax on capital is lower than that of dividend. So usually in the financial market, you see when there is lower transaction cost, now there is expectation that more dividend payout will likely also happen. Third, financial market with double taxation on dividend will be expected to higher dividend without double taxation, on dividend, will be expected to have higher dividend payout, similar to second one. If there is double taxation, that means dividend is taxed twice. If you tax my dividend twice, I will find a way of evading payment of dividend. I'll find another way of giving value to my shareholders rather than going through dividend where you will tax them twice. So truly, financial market without double taxation on dividend will be expected to have higher dividend payout, because both the managers are happy, both the shareholders are happy, knowing that we are not taking too much of their money through the various double taxation models. Third one, companies operating in high growth rate sector will generally be expected to have higher dividend payout. That's not correct. Why? When you are in a high growth sector, the sector is growing fast, you actually need a lot of money to plow into the business. So you are trying to conserve your money. So those companies will have a low payout ratio, a high retention ratio, because you need money. The sector is growing. There are opportunities to grow and make more money for your shareholder. You are looking for more money for people to invest into the business so that you can invest more and generate more growth. So usually, company operating in high growth sector would not be expected to have a higher dividend payout. They have a lower dividend payout. It's only when you don't have high growth rates. Growth rate are moderated. Whatever is coming in, most of it is not being plowed back into the business. You see them paying them to shareholders in the business. So D is the one that is the answer in this particular case. I'll just take one or two comments so that I can move on because of our time. HP005, what is your name? Oh, we don't have HP in this class. Oh, okay. Let me call on you, HP. Please tell us your name so we know we're speaking. Unmute yourself and speak. HP. HP005. We can't hear you.
Hello, sir. Oh, sorry. Okay, not me.
That's
not me.
Mr.
No,
Mr. Levi. You can go ahead and talk.
Okay, is that me? Okay, okay. I'm not HP, right?
No, you are not HP.
Okay. Sorry, I tried to look at the option that seemed to be the correct one, as you said, which is correct. We'll talk about high growth rate sector, right? The growth we're talking about, is it not expected to trickle down to the investors just as number one? That's option one we have there. I'm talking about the agency, the expectation of the owners who delegate the authority to run the business on their behalf. The business is progressing and the business is doing well. Would they allow permanent plowback of the so-called fund? So can we look at that one again and looking at the expectation of investors, even when the business is thriving and doing well? So is it not expected to trickle down to what goes to them?
Yeah, I got your point, but it's not about expectation, it's about business expediency. Even if it is you and me, I'm running a business. I made a profit of 100 million in my year one. But the business is growing so fast that my rate of return on equity is 60%. And the business has a lot of business opportunities. what will likely happen? I'm actually looking for more money. I'm asking people to buy more shares. I'm issuing more shares to the shareholders, doing rights issue. Rather than applying back, you will know that some banks in Nigeria that they are not doing well, but because of capitalization, they didn't do a lot of dividend last year. They withheld some money because they need the money for recapitalization. But the same way for a growth sector, a high growth sector is where there is a lot of opportunity for growth, and you are applying back money. So will you likely pay out a lot of dividend? You have already money which you can apply into business. You will now pay it out, and tomorrow you are looking for another money to invest. It's not consistent. So, but from finance point of view, all those gains eventually will come back to the shareholders in another form, capital appreciation and the rest. So the likelihood for managing the business in a high growth sector, managers will likely not pay out a lot of dividend. They will plow the dividend back. And that's why you see in the technology sector, especially in some other parts of the world outside of Nigeria, for years, Microsoft, all of those ones, they didn't pay dividend for the first 10, 15 years of their business. Some paid dividend only after close to 20 years because the company is growing. There's capital appreciation and things like that. You need more money to apply into the business. So you discover that technology companies in most part of the world, the more developed market, don't do a lot of dividend payout because it's a high growth sector where they are growing a lot of things. I mean, it's not about sentiment when it comes to those business decisions. It's about what does the business need. Not what makes the shareholders happy all the time, necessarily. Okay.
Sorry, sir. Hello, sir. Sorry.
Yes.
Sorry. The effect of what goes back to the investors, apart from the capital appreciation. Okay, let's talk about the effect of dividend on capital appreciation. Is there any correlation?
What determines capital appreciation mostly?
Or what influence?
What influences capital appreciation mostly? Yeah, a little bit of the rate of growth is a particular thing. Rate of growth of earnings per shares. If your earnings are growing very well, then you see that the companies appreciate further. You should have done this equation in under equity, where you relate your dividend discount model to the price earning ratio. You discover that, a company that has a very high rate of G will likely have a high rate of appreciation of capital. You get the point? They are not exactly the same thing that I have. They are not exactly here also. You are applying back. It doesn't mean this is still growing and it's still high. So the capital appreciation will still be high for the company. It doesn't stop the company from growing. You're applying a high amount of money back into the business. The business will likely grow higher when you have a high plowback ratio. Okay, I think we can just all read a bit more on this because of our time. Okay, Mr. Romanos, we've done another 2 hours.
Yes, sir.
I think
we have a 30 minutes break. Yes, sir.
And then we'll come for the last lap from 3:30 to somewhere about 5. I think we've done well in terms of managing our time, so we should be able to finish when we come back. So please, let's take 30 minutes off so that we can relax, let the blood flow, and then we'll come back 3:30.
Thank you, sir.
Thank you. Ladies and gentlemen, are we back?
Yes, sir. We are back, sir.
Yes, sir. We are back.
All right. Let's take on the last segment and see how far we go. Please, this came to my mind while we were on break. Most of our questions, we'll still talk about that, I think, in the very last session where we are talking about the specific structure of the exam. A lot of our questions, in fact, almost all our questions now are in OBJ form. Even when you have the case study will create a scenario, then you answer the objective questions that follow. Please always focus on what the question is asking. Don't start bringing related concepts that is not being asked in that particular question. This just came to my mind when I was thinking about this question I just asked. Which of the following statements regarding dividend policy is incorrect? So you are focusing on dividend policy within the context of any other thing that is said here. So don't think about, oh, okay, if you pay more dividends, your value will grow higher. That's not what this question is asking. If you pay more dividends, something I know. It says dividend policy, regular cash payout from the perspective of dividend policy can help to reduce agency problem. Just focus on that. But if you start linking other concepts to it, there are maybe possible different interpretations to it, and you may not get the correct answer. Because the question is specific to a particular subject matter on that particular context. Companies operating in high growth sector generally would expect to pay higher dividend payout. From the perspective of dividend payout and high growth sector, what will likely be the situation? Focus on those key words so that you don't run into possible mistakes. Okay. Another practice question quickly before we go to, I think the last section talks more about mergers and acquisition. So we'll look at the key issues there. So the required annual risk-free rate of return is 6%. So RF is 6%. Required annual rate of return on the security with a beta of 1.2 is 15.6%. So they have given us the return on that asset to be 15.6. Beta is 1.2. Using the capital asset pricing model, what is required annual rate of return on the market portfolio? So this is the formula. You will note that this is what is being asked. So any variable can be asked of you. So this question, normally the usual format you have this question is that you are given all the other things and you are asked to find the cost of equity, RA. So you plug in all the other items and then you find your answer. But sometimes this question is asking you to get what is the risk-free rate. If they give you the cost of equity, they give you the beta, they give you the return on the market, you should be able to find a risk-free rate. This one is asking for return on the market. If you have the risk-free rate, you have the beta, you have the cost of equity, you should be able to find RM, that is the return on the market. So it's just a simple case of making what you are looking for the subject of the formula from that equation, and then you can still solve the problem. So here, what I've done, make the return on the market, which is RM here, the subject of the formula, and then you can plug in all the other variables and you will get your answer. So return on the market will be equal to return on equity minus risk-free rate divided by beta plus risk-free rate. So I just plug in the various figures. I have 15.6 being the return on the required rate of return, RE. Risk-free return is 6% divided by beta is 1.2 and risk-free rate is 6%. Plugging all of that, the answer will be 14%. So that's one way to be sure that you can be asked anything. Just remember, as long as you're hearing things like risk-free rate, return on the market, they're asking you to use the capital asset pricing model. But it's not always that you use it to calculate the required rate of return on equity. It might be for any of the other variables in that particular equation. So in that last question, the answer is 14, C. Now, capital structure. What are the factors affecting capital structure? And then the theories of capital structure. Let's quickly look at that before we go to mergers and acquisition. So business risk affects the capital structure. A lot of businesses that are very highly risky have a significant amount of debt in their capital structure. So you have GRE that is very high. If you go to aviation industry, it's an example. Very high risky business, and so you see them taking a lot of debt in their capital structure. Debt tax deductibility, because of the advantage of tax deductibility when you use debt, some companies, as part of their financing strategy, use that. So that can affect the capital structure. There's a particular company in the US where they are equity is almost zero. That very little equity, largely debt financed, because their strategy is simply to use leverage for their business, and that's what they do. Highly risky businesses, we tend to do that. I don't know whether it's General Motors or one of these companies. Very high amount of debt in their capital structure. Ability to raise capital under adverse condition will also affect capital structure. So if it is difficult to raise money under certain conditions, people possibly will just go for debt, which will be easier than trying to look for equity. Then managerial decision is also important. A company might be pursuing a conservative or aggressive strategy. If you are conservative, you tend to use more of equity in your capital structure rather than debt. If you are more aggressive in your management decision, you can use a lot of debt and have a high level of gearing, 90% to 10%. But that's about the managerial decision making. And then the need to minimize weighted average cost of capital. So you want to reduce your cost of capital, you want to introduce some significant amount of debt into your capital structure, because debt is generally less expensive than equity. So these are all factors that can affect the capital structure. Various theories of capital structure, I think about 4 or 5, we just quickly mentioned them. M&M theory, I'm sure we are familiar with M&M theory. M&M has about 3 different theories on capital structure. Talks about one with zero taxes, where there is corporate taxes, where there is corporate and personal taxes. What would the company do? There is a trade-off theory, the signaling theory, pecking order, debt financing as managerial constraints, and window of opportunity theory. For M&M theory, says generally that there's an optimum. One of the theories is there's an optimum cost of capital, whereby you minimize the risk of bankruptcy against the cost of capital. At that point, you minimize your cost. The trade-off theory is the idea that a company chooses how much debt finance it will use by balancing the cost and benefit of bankruptcy, tax savings, and agency cost, similar to one of the theories of M&M. The signaling theory emanates from information asymmetry theory that says, the farm shareholders and management don't have the same level of information about the company. Because management has much more information, they are the one running the business. Shareholders don't have too much information. So if managers believe that their farm is undervalued, there's a way they will behave. They will issue debt first and then issue equity as a last resort, because they don't want to sell equities that are cheap. So if they believe that their country is undervalued, they will tend to issue debt. They don't want to issue equity. Conversely, if the management believes that their firm is overvalued, then they will be very quick to issue equity rather than debt. If more funds are then needed, that's when they will now issue debt. So that can signal to anybody to know whether the management consider the firm undervalued or overvalued. Then there is a pecking order theory, which says generally companies will raise internally generated funds first. So the company will exhaust all the opportunities to raise funds internally because they are cheaper, no flotation costs, no negative signaling, and so on and so forth. So that is the first thing to do. However, if more funds is now needed, then they can issue debt if you go on with debt because it also has lower costs. So cost is a major consideration when you are talking about pecking order theory. And then lastly, it is equity. When more funds are needed, they then go to equity. So internally generated funds first because that one will not cost you much and it doesn't give any negative signal. If you need more money, go for debt. You then need more money before you go to equity. That's the pecking order. So there is a pecking order in which organizations raise money. Then financing and agency cost. Regarding some of the theories we have said, one agency problem is that managers can use corporate funds for non-value maximizing purposes. I mentioned that earlier. So it's always a problem in agency theory that the managers tend to use corporate money in a way that does not maximize value, just for their own benefit. So sometimes one of the ways to solve that problem, the use of financial leverage can help. Bonds, free cash flow. So if you have borrowed money, you are forced to be disciplined as a manager to avoid unnecessary pegs and non-value adding acquisitions because you are focused on repaying the debt. Because you know that if you don't repay debt, actually the company can go into liquidation or bankruptcy because the creditors can actually ask for the company to be liquidated. So debt financing can help to manage the agency problem and reduce agency costs as well. So these are theories. Please revise these theories if you understand basic questions that can be asked on agency theory. There's another question here with solution. I will just rush through it. Gobi company has a redeemable 4% loan note on issue with a nominal value of 20 million. Current market value of the loan note is 10 million. Tax rate is 25%. Equity shares of Gobi have a total market capitalization of 30 million naira. The company's weighted average cost of capital is 10%. What is the cost of equity for Gobi company? So once you see a question like this, it has talked about the cost of loan note, that's cost of debt, and the nominal value of debt. It has talked about the market value of the loan note. It has talked about the value of equity, and it has talked about the weighted average cost of capital being a particular amount. So this question is expecting you to link all the various segments of the cost of capital to the weighted average cost of capital, and then use that one to derive what the cost of equity will be. So you can't use capital asset pricing model when it's talking about all of this because you don't have anything like beta, you don't have anything like return on the market. So you must be talking about the weighted average cost of capital, how it relates to the other. So just bring out the formula for the weighted average cost of capital. WACC equals weight of debt multiplied by cost of debt into bracket 1 minus T plus weight of equity multiplied by cost of equity, which is equal to 10%, because we were told that WACC is 10%. So when you have 10%, you have all the other ones. You know the weight of debt, we've been told. You know the cost of debt. You know the weight of equity. You know the tax rate. The only thing you don't know here is the cost of equity from this equation. So make the cost of equity the subject of the formula. So cost of equity equals 10% minus 0.75% into bracket multiplied by 4/3, which is equal to 12.3%. I'm just opening our minds to the various ways the examiner can just bring in question. You would think it is new or something special. Is what you know. It's just your ability to think through and just try and resolve the problem. Yeah, somebody wants to ask question. Former, you can go ahead.
Okay, thank you, sir. So what's the difference between the nominal value of the debt and the market value of the debt?
Okay, that's another good question. You see, in capital structure, the ideal value that you use is the market value of all those different components of weighted average cost of capital. So you can have a question that gives you the nominal value, and the market nominal value is the par value. But because the debt is traded in the market, the value in the market value will not always be the nominal value. So the nominal value is the par value. So if you issue 200 million security in value, and then you go and put it in the market and it's now tradable in the market, depending on the interest rate situation in the market, the cost can go up, the value can go up, or it can go down, depending on the situation in the market. You know, there's an inverse relationship between the interest rate and the value of debt. So when that happens, because it's traded, the value might be different. So, but the summary is that when you are doing weighted average cost of capital, you are expected to use the market values of both the equity, of the debt, of the preference shares, if you have access to the market values. Now, if you don't have access to the market value, you use nominal value as an approximation, but it is not that, it's not as correct as when you use the market values for your calculation. So ideally, you should use your market value for calculation.
Thank you.
Somebody said, thank you. How did we get the proportion weight of debt as 1/4? Who can help us? We have the current market value of loan note to be 10 million. Okay. And then we have the market capitalization of equity to be 30 million. That is another word for the market value. You are finance people, capital market people, so you should know market capitalization. Market capitalization is the value of equity. That one is 30 million. 30 plus 10 is 40 million. 10 over 40 is 1/4. That is the weight of debt in the capital structure. Weight of equity is 30 over 40. That's why it is 3/4 in the capital structure. You get it? Thank you. So, last practice question before we go to mergers and acquisition. AB Limited recently evaluated an investment project that had an initial cash outlay, followed by positive annual net cash flow over its life. The company employed the internal rate of return and discounted payback period. Remember, we've dealt with all of this earlier today for the investment appraisal. Later, it was discovered that the cost of capital figure was incorrect and that the correct figure was higher. What will be the effect on the internal rate of return and discounted payback period of correcting this error? Can you see? This one does not even require you to calculate anything. It's about thinking. You evaluate later an investment project with an initial outlay followed by positive annual net cash flow over the period. Company employed internal rate of return and discounted payback period for the investment appraisal. Later, it was discovered that the cost capital figure used was incorrect and the correct figure was higher. So the cost of capital is meant to be higher. So if you now use a higher cost of capital to discount those cash flows, what will be the effect on the internal rate of return and DPP by correcting this error? So what will happen to the internal rate of return? Will it change? Somebody to help me.
It would
What will
have no
happen to internal
effect
rate of
on it.
return? Eh?
It would have no effect on it.
Why?
Because internal rate of return is used to calculate the cost of how do I explain it? I don't know how to explain it.
I want to help you. You know, you tend to know what you're saying. The inherent return of the project itself. The inherent return of the project is what you use the IRR to calculate. That's what IRR means. Your own cost of capital cannot affect the internal rate of return of a project. It is a set figure for itself, irrespective of the cost of capital of the different companies using it or whatever. A project has its own internal rate of return. So even if the cost of capital of a company is higher or lower or the same or different, it doesn't affect the IRR. IRR of the project remains the same, irrespective of your own cost of capital, because it doesn't depend on your company's cost of capital. That is why there will not be any change on the internal rate of return. But for the discounted payback period, each company uses its own cost of capital to discount the cash flows, to get the discounted cash flows before you can now get the discounted payback period. If you use a higher figure to discount cash flows, the amount of cash flow will become smaller. So if I use 20% to discount cash flow, the present value will be smaller because I'm using a bigger amount to divide it. And now, so if I divide it and the figures is coming out from it is smaller, it will take a longer time for the project to record it to break even. So the discounted payback period will be longer. It will increase because with higher discount rate, the figures that we'll be getting as present value is smaller. And when you have a smaller value that you are compounding and adding together, it will take a longer period before the project will pay back than if it was a smaller figure. So for IRR, there will be no change. For discounted payback period, there will be an increase in the period. See the way we are thinking, and that's why you won't be able to know this if we didn't do those physical method, the way we did manually calculated those things. And that's why I said we should go through that process. It will help us to appreciate it a bit better. Okay, so these are the kind of simple questions, thinking questions that you might come across in the objectives of your questions. So amount of valuation of mergers and acquisition. All of us are familiar with mergers and acquisition. We've seen it practically in our environment, Nigeria, outside Nigeria. Mergers and acquisition refer to aspect of corporate strategy and corporate finance and management, whereby a company tends to want to grow by acquiring another company or joining together to another company. It deals with buying and selling, combining of different companies that can aid, finance, or help a growing company to grow rapidly without having to create another business entity. Some companies, rather than grow organically, growing organically means you just grow at your own pace. You expand, get new branches, expand your market. It can take you a longer time to grow that way. So some people have perfected the art of mergers and acquisition. And the example in Nigeria would be a bank like Access Bank, which some 20 years ago, those who are familiar with the Nigerian market, Access Bank was one of the small banks in Nigeria. But over time, it just started acquiring, expanding, acquiring. And today it has the largest asset base among Nigerian banks. So that's one model for growth. So merger generally means two firms, often about the same size, coming together to become a single entity rather than remain separately owned or operated. It's a combination of equals most of the time. Both company stock are surrendered and a new company stock is issued in its place. Both cease to exist and a new company is created. That is merger. The second one is acquisition, where usually one company is larger and stronger than the other, and therefore buys over the second company, clearly establishing itself as the new owner. Yes, from a legal perspective, the target company ceases to exist while the buyer swallows the business and the buyer stock continues to be traded. So most of the time, the larger or the stronger entity buys up the other one, issues shares of its own to shareholders of the other company. The other company ceases to exist, and therefore the bigger company continues to exist with a larger share base based on what has been issued to the shareholders of the smaller entity. There are related terms that we need to learn: takeover, management buyout, leverage buyout. Please get familiar with all of this. I've explained some of them here, but it's good to be familiar with those terms. Related merger, reverse acquisitions, spin out, demerger. All of these are terms that relate to the concept of mergers and acquisition. Just get familiar with it, those concepts. Since I will send you the materials, that should not be a problem. And also, this practice question is on the capital asset pricing model. Well computed solution is there. So I don't know. I don't think I want to solve this one. Let's read the question. Let's see whether it is worth spending some time on. But I think you should be able to sort this out. The shares of Disco Limited have a beta of 0.6, and the shares of Combo Limited a beta of 1.5. Investors in Disco Limited have an expected rate of return of 8%, and the expected return to the market at 10%. Using the capital asset pricing model, what would be the expected return of expected rate of return for investors in Combo Limited? So our knowledge of capital asset pricing model is what we are trying to get here. I think we should try it. If anybody faces a challenge with it, please let me know, and then we can sort that out. Okay. All right. So don't let us solve this one. I've just given us a lot of questions to practice. The solutions are at the back, so you can be familiar with the typical kind of OBJ questions that we set in this question. There's also number 9, number 10. Please go through them, try and solve them. If there's an issue, refer back to me, and I will gladly help us to address it. And please, Mr. Romanos, let the class have a lot of the past questions for their exercise. For me, one of the things you need to do regularly is solve as many questions as possible. Don't just read materials. Those things don't help as much. Once you have read the material, you get the general concept, it's fine. Then practice it, put it to practice in trying to solve past questions, as many of them as you can. So let's go to mergers and acquisition in full force. So why do companies do mergers, go into mergers and acquisition? The key word is synergy. Synergy means 1 + 1. That's the illustration they give us in finance class. 1 + 1 equals to 3. Ordinarily, 1 + 1 should be equal to 2. But when you have a situation where two companies come together and somehow there's something, a synergistic effect that now make 1 + 1 equal to 3, then you have synergy, and there's a rationale for mergers and acquisition. It can take the form of revenue enhancement or cost savings. Sometimes two companies come together and they significantly reduce. Maybe there are places where there is overlap of cost between the two companies. Now that center becomes only one cost center. They close down the second cost center, and it doesn't affect the overall operations. They discover that cost is reduced and revenue can be enhanced, and the company does better. Sometimes due to staff reduction. So company A has 100 staff, company B has 100 staff, total of 200 staff. The two of them come together, they discover that they can work with 150 staff instead of 200 staff. So the 50 staffs are redundant, they are let go. So you save that cost And then with 150 staff, you are still doing the business that the two other companies will have done. That's a way of reducing your cost. Economies of scale. Two companies come together and the economies of scale just expand. They're able to do something larger at lower cost. And sometimes as you expand your horizon, your average cost of operation drops. And that's one way of economies of scale. Another one, acquisition of new technology. So a new technology, one of the companies may have the new technology. By combining with the second company, the technology is able to handle the overall operations of the two, and therefore enhancing the efficiency of operations. Improve market reach and visibility. So sometimes one company has very good market reach in some part of the country that the other does not. Now that the two of them are together, they have access to larger markets and they can sell their product more. The advantage of diversification, it could be product diversification, geographical diversification, and market segment diversification. All of these are possible ways by which synergy can be derived from mergers and acquisitions. Okay. Various types of mergers. We have horizontal mergers where competing companies merge together and become one. So we call it horizontal one. Vertical one, where buyer and seller relationship companies. So a company that supplies something to another company is acquired by that other bigger company, and then they become part of the same group. So a cone supplier merging with an ice cream selling company, or a company that produces some parts of a vehicle in the vehicle manufacturing process being acquired by the vehicle manufacturer now. So it becomes just a department or a unit in the larger company. Then we have conglomerate mergers where neither competitors nor buyer-seller relationship exists. So the company can acquire another company in a completely different line of business, but they become part of a larger one company. So these are varieties of mergers that can happen. Now, the key thing for us is valuation in mergers and acquisition. So when two companies come together, we want to then do valuation. What was the state of the two companies before they merge? What happens after the merger and acquisition? So merger and acquisition, or indeed any situation of the business combination, will usually require the valuation of the two companies involved. Appropriate and mutually acceptable valuation is one of the challenging aspects of mergers and acquisition. Various models can be used: balance sheet valuation models, book value, liquidation value, replacement value. These are all not very, very useful from the perspective of finance, because the balance sheet looks at just the historical asset of a company. When we are talking about real value of merger and acquisition, we're looking at what will likely happen in the future, the value that will be created in the future. So these models don't tell us a lot about what will happen in the future. So I have mentioned them, but they are not very, very useful models. But these other models that we are familiar with, that we can use to project future cash flows, future returns, future dividend, these are more useful. So the dividend discount model, the no growth model, constant growth model, differential model are used commonly in valuing mergers and acquisition. Similarly, valuation relative methods, price earnings ratio valuation, price to book value, price to sales, enterprise value to sales, enterprise value to EBITDA. We are all familiar with all of these relative valuation models. They are used to value mergers and acquisitions as well. Earnings-based model, maintainable earnings, earning yield, average historical earnings are used. And then we have the cash flow-based models, free cash flow valuation models, the DCF that we are very familiar with. It's one of the most commonly used models for valuing mergers and acquisitions because of the advantage of being able to project future cash flows expected from the new entity that are merging together. And then we discount at the new expected weighted average cost of capital to find what the new value of that company will be. So DCF model still remains one of the best that give us a good idea of what the valuation of merger and acquisition would be like. So that's just as a form of background. We can take a few examples that will open our minds to how we can go about this. Look at this question 11, practice question. It says, Alpha Textile is contemplating the acquisition of Omega Industries. The values of the two companies as separate entities are 20 million and 10 million respectively. So Alpha is worth 20 million, Omega is worth 10 million. Alpha estimates that combining the two companies, it will reduce marketing and administrative costs by $500,000 per year into perpetuity. So this is where the synergy is coming from. The synergy is a reduction in the marketing and administrative cost of the two entities. Alpha is willing to pay 14 million cash for Omega. The opportunity cost of capital is 10%. The first question, what is the gain from the merger? The gain is the synergy. That synergy is a reduction of 500,000 per year, but in perpetuity. That means it continues forever. What is the present value of a perpetual cash flow? That is that cash flow divided by the appropriate cost of capital. I've said that today. When you are valuing anything into perpetuity, there's a cash flow into perpetuity. Once you know the cost of capital and you know the annual cash flows that comes in, that annual cash flow divided by the cost of capital will give you the present value of the perpetuity. So in this case, $500,000 divided by 0.1, because we are told that cost of capital is 10%. I mean, the present value of the synergy is $5 million. Now, what is the cost of the cash offer? What will it cost the company Alpha Textile to acquire Omega Industries? We've been told that Omega Industry is worth 10 million. If you value it separately on its own, it's just worth 10 million. But Alpha is willing to pay 14 million cash for it. So there's a premium. As a premium it is paying over the normal cost. It should have been 10 million. But of course, there is no incentive for the owners to sell. If you want to buy it and tell them it's already worth 10 million before you made your offer. So why should they sell? So most of the time, the buyer in an acquisition, we need to pay a premium. That premium is the effective cost of the acquisition to the acquirer. So the company is paying 14 million for something that is generally worth 10 million on its own, so separately. So 14 minus 10 million, there is a 44 million premium being paid for it. So it is costing Alpha 4 million to acquire this company because it's paying more than the normal value of that company. So what is then the net present value of the acquisition under the cash offer? The company is gaining 5 million in present value. It is costing it 4 million in present value. 4 million minus plus 5 million minus 4 million will give us a difference of $1 million. So the present value of this acquisition to Alpha Textile is $1 million. That's the way to think about mergers and acquisition. So what is it costing the company now? If you know what it costs the company, what is the gain that acquisition will bring to the enlarged entity, to the company? The difference between the two will be the value of that acquisition. Question? Comment? Okay, everybody's fine. I'm trying to check whether there's anything in the chat room. No? Okay. Are we together, class? Can I hear somebody's voice?
Yes.
Yes, we're with you, Doctor. We're with you. Go on.
Yes.
Great.
We're enjoying this second segment.
Ah, that's good. Somebody's raising their hands. Mr. Wale, can you ask your question? Go ahead. Wale, can you unmute yourself? We can't hear you. We can't hear you. Wale Odofin Bello. Wale Odofin Bello. Okay, Mr. Akinyemi Hassan. Akinyemi Hassan, can you go ahead? Go ahead.
So going through
Your voice is very faint. Your voice is very faint. I can't hear you.
Can you hear me now?
Just slightly better.
Hello. It's okay. Can I go ahead?
Go ahead.
It's okay. In respect of the last question that you solved, the merger and acquisition, going through the question, what type of merger is that? Is it horizontal? Is it vertical? Is it a conglomerate?
I can't hear you.
Hello, sir.
Yeah.
Can you hear
Go
me now,
ahead.
sir? Yeah. I said in respect of the last question you solved on merger and acquisition,
Yeah.
can we deduce the type of merger that actually occur? Is it a vertical merger? Is it a conglomerate merger or an horizontal one?
We were not told. So, and it's not, and we don't need to know. It doesn't affect our answer.
It's okay. I was only trying if you can deduce.
We can deduce, but why is it important? It's not relevant now. I think, yes, I think we can deduce because it appears that there are companies that are doing similar businesses. That's because from this, it says after estimate that combining the two entities, it will reduce marketing and administrative costs by $500,000 per year. That means they possibly are already doing similar type of business before. So it's more like a horizontal merger between competing companies. It's not likely going to be a conglomerate merger where they are doing completely different things. If they are doing completely different things, how are they going to merge together and be doing this thing? It doesn't look like a vertical merger, because in a vertical merger, one of the companies is supplying the inputs to the other one. So this one look like a horizontal merger. Two companies already doing something similar, so they just merge their operations together. But honestly, don't worry. It's not for this question. It's really not an important. We were not given the details, and it doesn't affect our answer. That's what I meant. Yeah.
Thank you.
Thank you. Mr. Akinyemi, can you talk now? You raised your hand before. We couldn't hear you. Mr. Wale or Mr. Levi, any of the two of you that can speak, just...
Okay. Hello, sir. Hello, sir.
Who is speaking?
Levi is speaking. Mr. Levi is speaking now. Yes, sir. Sorry, I tried to take it from where that where the last speaker asked the question. This one, from this example, of course, it's not relevant in this question, but as an example of a variety of merger, I don't think this one fits. I just said it's not an instance of merger; it's an instance of acquisition. I think there's a difference between acquisition and merger. So if we want to use it for an example,
they are slightly different.
So in this instance, there's no merger here, but it can be an example of acquisition. So that's what I just wanted to say.
Okay, thank you. You are correct. We were even told specifically it's an acquisition. So, Mr. Wale. Mr. Wale is just raising his hand. We can't hear him more. Or maybe he raised it by mistake. Okay, so that's it. For question 11, I've tried to explain it to make it easier to understand. I expanded, I gave us an additional question here so that we can work on. I think I have a comprehensive solution for that. I don't know whether I gave it to you. Question 12, yeah. There is a solution there for us. A, B, C, D, yeah. I want us to try this question. And I want to see as many of us can get and understand it. If there's something you don't get there, let me know. We can discuss it. So, very good question because it covers a wide area of mergers and acquisition. Using PE ratio is another one. What we have used, the first one we did, we are talking about NPV. But the second question is saying Castle Limited currently sells at a price earning multiple of 10. This is another way these questions are set. It will tell you the price earning multiple at the beginning, and then when the companies merge, the price earning multiple, and then what's the new earnings. From that, you can deduce what will be the new value of that company. So Castle Limited sells at a price earning multiple of 10. The firm has 2 million shares outstanding and sells at a price per share of $40. Mountain Limited, that's the other company, has a price earning multiple of 8, has 1 million shares outstanding and sells at a price per share of $20. So 2 companies now who are either being bought or merging. If Castle acquires the other firm by exchanging one of the shares for every 2 of Mountains, what will be the earnings per share of the merged firm? Good question. So there's a merged firm now. Castle acquires. So you need to know where we are now. When the merger happens, how many earnings per share remains? Then what will happen to the earnings per share of that company? I want you to think about it and try and solve it. What should be the price earning of the new firm if the merger has no economic gains? What will happen to Castle's price per share? Show the shareholders of neither Castle nor Mountain realize any change in wealth. So we are creating a different scenario where I think this is a question I would love us to solve when we come for the final class. I think maybe the final revision class. But I want you to have gone through it, thought through it, and then if at that time you don't understand, you can just look at it together. So these are the kind of format that the mergers and acquisition questions can come. It's a comprehensive question, which I like. What will happen to Castle price per share if the market does not realize that the price earning ratio of the merged firm ought to differ from Castle's pre-merger ratio? How are the gains from the merger split between shareholders of 2 firms if the market is full as in part C above? So I think you have a guide already. I've tried to do some summary of the solution, but that's not the important thing. You can always find solution, but the thing is to understand what we are trying to do in the class. So mergers and acquisition, very important topic which we need to work at and try to learn how to solve it. So I please to solve that second question, and also the question on 2 questions already that I've given us that we need to work on. One on MPV and RR, that one on General Motors. I want us to solve it together as well. So we already have a couple of questions to solve. So looking further on mergers and acquisition, we have various defense strategies for merger and acquisition. So companies tend to want to protect themselves against being acquired suddenly. These things happen very, very seriously in markets. Even in Nigeria, we've seen cases like that, where people suddenly swoop on the shares of a company. Before you know it, somebody has bought and become a majority holder. One of them happened recently with, is it Transcorp? Not too long ago. So this happens a lot. But to protect themselves against that, companies have developed strategies, which we call defense strategies against mergers and acquisitions. Let's get familiar with some of these strategies and how they are used. There's something called poison pill. This includes the dilution of shares of the target companies to make it more difficult and expensive for a potential acquirer to obtain a controlling interest in the target. So if a company knows that there's a lot of target on it, it can dilute its shares such that it is more expensive, it is more difficult for the potential acquirer to obtain a controlling interest in that company. And that's what is referred to as poison pill. So it has a lot of different names used to describe those strategies. There is also something called poison put. This aims to increase the total cost of acquisition. It involves the target company issuing bonds that can be redeemed before their maturity date in the event of a hostile takeover of the company. So they issue bonds, and it makes it more costly for any company. If you acquire that company, you are going to be responsible to pay for those bonds. So they issue it making it more challenging and more difficult for somebody who just wants to acquire the company. So there's something called golden parachute. It refers to benefit, bonuses, severance paid due to the company's top management staff in case of termination of employment as a result of hostile takeover. So they put in place clauses to ensure that the management, the top staff, will get some hefty benefit and bonuses of severance pay in case they want to terminate them upon being acquired through a hostile means. So if that is put in place, it discourages any potential acquirer of such company. There's something called Pac-Man's defense, where the target company tries to acquire the company that has made a hostile takeover attempt. So instead of allowing the company that wants to acquire you to quickly, you outwit the company by acquiring it before it can actually acquire you. So in an attempt to scare off the would-be acquirer, the takeover target may use any method to acquire the other company, including dipping into its cash reserve to buy a majority stake in the other company. So it's more like you going faster than that company and ensuring that it's difficult to acquire the company. Supermajority provision is an amendment of the corporate charter stating that a merger or acquisition of the company can only be approved by the board if a very large percentage of its shareholders, say typically 70 or 90%, vote in favor of it. So this can be put in the provision of the corporate charter of that company, and once it becomes legally binding, it's difficult for anybody to do otherwise. Green mail defense refers to the target company buying back share of its own stock from a takeover bidder who has already acquired a substantial number of shares in pursuit of a hostile takeover. So the target company can buy back its share from its own stocks, shares from its own stock on the takeover bidder. So all of these are different provisions, techniques that companies have adopted over the years to protect themselves against hostile takeover. This is a practice question and OBJ again that's similar to what we've talked about. A takeover defensive strategy whereby the target company makes a counter bid for the stock of the bidder is described as, we have just answered that as Pac-Man defense, that's number 4 here for that company. All the questions that we try to solve, I think some of them may not have the answers there. I've tried to list the solution at the back so that you can refer to it. Ladies and gentlemen, I want to give us some time to address 1 or 2 questions before we round up this class. And then if you have any general questions that possibly we've not touched something in this class specifically, it's a wide syllabus, we may not have touched everything exactly, but so I want to give us time to do that. Yep. Over to the class. Questions? Comments?
Good evening, sir.
Good evening.
Yes, thank you
Go
for
ahead.
this amazing class. Really wonderful and very insightful. So this is what I should ask regarding the green mill defense, where the company buys back its share from a potential hostile takeover. Are there cases where it becomes difficult or impossible for the company to buy back its share from that hostile takeover company?
Yeah, I think I won't say exactly the ways, but I think there will be some provisions there. Maybe they will have put some legal provisions that make that possible there. It might be deep because I can imagine that the takeover bidder would not even want to sell those shares. But if they have incorporated it into certain provisions and charters, there may not be it can be legally binding on that company. So to be honest, I don't know exactly how that will play out, because I can imagine that the takeover bidder will not want to sell, knowing that he wants to keep that substantial number. But there may have been some legal provisions, that will make that possible for the company. So I agree with you. I think it might be challenging, but if it is proper provision is made for it, especially legally, then the acquirer may not have any choice other than to do that.
Thank you, sir.
Okay, thank you. More questions, more comments? Generally on this corporate finance in the course of your study or lectures, what areas do you have any challenge you think we can discuss in this class? Okay, Former, go ahead.
Yeah, thanks once again, sir. My concern is in respect of preference shares. I understand that it is treated like debt, and what does it mean when we say that preference shares are like debt? Taxes, are they tax deductible as well when computing the cost of preference shares, or you just solve it like annuity and don't recognize taxes?
Yes. Preference shares we call them amphibole securities. Amphibole in that they have some qualities of debt, they have some qualities of equities, but it is taken they are closer to equities from the perspective of capital structure than debt. So their relationship to debt is that usually they have a fixed amount of dividend that is paid into perpetuity. Their own dividend is not like equity, where I pay you 2 naira last year, I'm paying 2 naira 50 kobo this year, following year I'm paying 2 naira, because your level of risk you are taking is not as much. So to that extent, it is closer to equity in the fact that their own dividend is not tax deductible. So you don't treat it like debt, where debt interest is tax. I hope you know what I mean when we say it is tax deductible, in that debt interest is deducted before you get to profit before tax and profit after tax. But dividend that you pay to ordinary shareholders, dividend that you pay to preference shareholders, comes as appropriation after you have actually declared your profit after tax. You then appropriate dividend to equity holders and preference shareholders. That way, it's not reducing your tax liability. You have already paid the tax before we appropriate to you. So preference shares are not tax deductible. That's why we don't say into bracket 1 minus T, which we do when we are talking about bond. You say YTM into bracket 1 minus T. That is what shows the tax deductibility of bonds. But for preference shares, no. It's an appropriation of profit. The dividend is an appropriation of profit. For most of the time, the dividend is also fixed, meaning that it doesn't increase from year to year. And that's why we treat it the way we have treated it, like perpetuity that we have treated. So it's closer to, overall, it's closer to equity more than debt, even though it shares the features of debt and equity, one form or the other. Does it? I hope that answers your questions.
Yes, it does, sir. Thank you.
Thank you. Okay, ladies and gentlemen, this is 4:30. I want to encourage us to practice a lot of the things I've given us. If you can solve all of this problem we have done in this class today, honestly, corporate finance should not give you a big problem in the exam. At least you should be able to get your adequate marks to be able to move on. So, ladies and gentlemen, I will hand over to CIS team. If there are no further questions, I think it's been a day well spent for all of us. In fact, I did faster than I thought we would do. So, but I want us to practice so that we can come back with questions. And if you give me feedbacks early, I can know what I would then incorporate into the final revision session so that everybody can benefit from that at the next class. Let me quickly check the chat room. Let me quickly check the chat room for 1 or 2 questions and see what people are asking. Sorry, is this class for level 1 or level 2? Well, it's for the 2 levels, but I think we've gone deep enough to help level 2. And there are so many aspects that are also relevant to level 1. So whether you are in level 1 or level 2, you should have something to take advantage of. But it has covered the syllabus of up to level 2. So if you are in level 1, there are some materials that may not be tested at your own level, which we have done today. So identify those ones, so don't bother too much. Maybe you can focus on your own syllabus. But then we've done quite a number of the areas are an overlap that will be useful both for the level 1 and level 2. Somebody is asking for the mode of the exams. I think Mr. Romanos will be talking a lot more about that. And I will talk a lot about that at the last session where we do the general revision. I'm going to spend the whole day doing general revision of all the areas that I'm going to be taking. So I will talk a bit more about that at that point. So I think that will be it for me. So, Mr. Romanos, over to you, or Damilola.
Thank you very much, sir.
Thank
we
you.
Really appreciate for that. We really appreciate you today, sir. Thank you for your being available for us today, sir. Before we go, I want to quickly let us know what is happening between tomorrow and on Monday. Tomorrow we're supposed to have a class on Physicom, but the person that is supposed to take it will not be available tomorrow. But we are making an alternative for tomorrow's classes. But for now, that has not been confirmed. That will be confirmed before later today, I will confirm that. So please, I will put it on our platform if we are going to have classes tomorrow. Otherwise, everything continues as planned from Monday. Mondays till Saturday, we'll be having till Friday, we'll be having our classes from 7 to 10 p.m. Please. I know I've explained that one before in our platform, that during the week, our classes start 7 to 10 p.m. So before the end of today, I will let us know if you are having classes tomorrow. Otherwise, everything continues on Monday as usual. Thank you very much for being part of today's classes. And I know all of us will enjoy our classes today. And I pray we continue as planned tomorrow or Monday. Thank you very much. Bye-bye.
Thank you, sir. Thank you very much, sir.
Thank you, Bro Romanus. We enjoy everything. We look forward to getting more information from you as concerned tomorrow.
Thank you very much. That will be done. Thank you. We appreciate it.
Please, when do we get the questions so we can start looking at it?